I bring up that before we take a brief break here and swap out Dylan and Bree and Glenn, I want to just point out the 2018 chart in the S&P 500. We got through the early year trade shenanigans, right? The trade war kicking off. And then you recover through the summer months into the fall. And then the data really starts to bite. Of course, that concludes with the plunge protection team coming in over Christmas break to save things, if you will. And again, a beautiful bullish engulfing bar down there on the 26th. But the point is that if we've moved away from the extreme. The extreme tail risk scenarios have been clipped, if you will. And this is a market where a lot of people are off sides in the short term or underinvested. And we are back in a boy who cried wolf mentality where kind of like January, February, where you hear a lot about this stuff and the market goes, okay, whatever you say. It means that in order to scare the market moving forward, you're going to need a new escalation beyond what we have seen at its maximum peak prior. Or we're going to think that it's just a negotiating tactic on the path to an ultimate resolution moving forward. So, Ilya, I mean, like, what brings us back down here?
Unless we are done with this part of the story and it's just the regular recession now.
Right. But that could take some time for the market to... And at this point in time, Dylan, I mean, before we let you go, if the economy does go into a recession, right, we have another quarter in the second quarter where it's contraction, isn't there part of you that thinks the market will just go, well, yeah, we know. We had all that trade stuff in April.
Rear view mirror.
We're obviously
and that's the whole thing. Is in that first quarter, what you saw was all kinds of mess around the tariff stuff, but weak consumption. You get another quarter of all kinds of tariff mess, but even weaker consumption. It'll be difficult to ignore.
We're going to take a quick break here on overtime. We'll be back in about 90 seconds. And Dylan Radigan is out. We're bringing Glenn Freiberger from Tasty FX to talk FX markets and some of the new product updates that we have here on the platform. Be sure to stick around. Be with you in a moment.
If you missed the live show, here's our cherry on top weekly recap.
Tomorrow is your big day. Are you going to get all your shopping done tomorrow?
What tomorrow? What's tomorrow?
Tomorrow's Saturday before Mother's Day.
Oh, yeah. We got that. This is...
Oh, yeah. Yeah, I've set the bar low. I'll go to Trader Joe's this afternoon, pick up a car, and I'll be done.
Wow.
By this afternoon and then by Saturday for sure, it's so picked over. You actually are like, you have to cross out, love your son and put husband there. There are no more cards.
No, the only card that's going to be left for Tom, it's going to be like, to my strong black queen.
Tom, how was your weekend?
My weekend?
Yeah.
Pretty good. I didn't really do anything. I worked at a coffee shop a lot.
He worked a coffee shop. Like, what do they trust you with? A broom?
Oh, no, they don't trust me.
No, I think he's more of a greeter.
If they need something, I'll go get it.
Like in the back?
If they need something.
No, like if they run out of milk or something?
Yeah, like
they
that.
must run out of butter every day. Like, sounds like we're out of butter. Sounds like, I just bought 4 pounds yesterday.
Oh, that's how they get rid of... Oh, that's how they get...
I'll go get some.
That's how they get rid of them?
How's your TV doing, Tom?
I don't watch
you're going to put Tom into the conversation?
I only watch sports. I stopped watching TV.
He's got other things to do like TikTok.
I got other things in my life that are more important.
TikTok.
His TV doesn't work. That's what it comes down to.
I have a TV that works.
Where is it?
It's not in the bedroom where you eat.
Yeah, there's no way. Where's your TV that works?
Big screen.
In the No, it does not.
It does.
In the living room?
Yeah.
No, sold.
Thomas, you look off a little bit today, Sadnov. What did you do? Did you forget something at home?
Don't you dare start.
I saw things in the office yesterday, and I was just like, what is even happening?
What'd you see?
I saw Beth holding a phone, pointing it at your hands, while a very nice Indian man asked you questions through a phone.
Like,
you're in trouble now, Sad.
Yeah, don't you have viewers that care about you? Don't they send you like
medicine?
Veterinarian, don't they send you like horse pills or something? Yeah. But did you wake up like that, or did you go to bed like that? Because if you went to bed like that, wouldn't you be a little alarmed?
Actually, he did go to bed like that. I did. Talking about it yesterday.
Yeah, it's from 2 days. It's the second day, but it's. Listen.
Do you think this is from rancid hummus?
Could be. I have a tolerance for pain that's a different level than you.
Oh my God.
Get the full scoop by checking out the archives at tastylive.com.
We are back. Welcome back to Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Glenn Freiberger in Chicago, joining us from TastyFX to talk about the turn in the U.S. dollar, as well as some exciting product updates that we have here on the platform. Glenn, welcome to the show.
Thank you. Thank you for having me. First time on it. Excited to be here with you guys. How's the day been? I mean, man, what a start to the week. Chris, I know you've got a lot of day left. We've got a Knicks game tonight. Big one.
Yes, we do. Listen, the game the other day was pretty bad. My brother's a sports bettor, right? So I call him up and I ask, what are the odds that the Knicks do this again game 3? He goes, well, Chris, and he spits all these numbers at me. And I said, all right, so I should probably bet against the Knicks or game 3.
Yeah.
So at least we have that going for us.
The chances of a Knicks Golden State final are slipping through our fingers, Chris.
It's not going to happen. And, but this is a big day to have you on, more importantly, because of what's happening in the FX market. The dollar has a huge performance today, in part because of this tariff announcement. Euro dollar down, pound dollar down, dollar yen up. People looking at the platform here, though, if we could go to it quickly, may notice something new that I know that you want to discuss. Ilya and I come from the spot FX world by vocation originally, and now in the watch list here on the platform, there is a Forex, all Forex pairs page. While I can't trade any of them yet, it does tell me something's coming soon.
Yeah, there you have it. From your watch list left rail or, your full watch list tabs, we do have now what will be the full product offering for the integration with TastyFX coming very soon. We can count down from days now over the next couple weeks here. So you can see what the overall offering will be. Right now we have the bid, the ask price, the mid price, net change coming soon, which will be helpful. But if you want to get on the wait list there, you can click on any FX symbol, join the wait list right there, and then you'll be notified the minute we have Forex trading on the platform. So a lot of exciting stuff. I know you guys are excited to trade it here on the Tasty Trade platform. But yeah, I mean, what a week to be starting to launch this stuff, because I know you guys have touched on it, but exciting news over the weekend. We kind of thought it was coming, but for the spot market especially, a lot of a hangover effect last week from all that crazy volatility, a lot of volatility coming in. Pete Mulmat and I look a lot at the daily ranges for a lot of these pairs on Forex Focus in the morning. Last week, it was ranges were really coming in. This week, we expected to be, we have CPI tomorrow, a lot of U.S. data points after kind of a nothing burger from the Fed. But we got a real jolt this morning over the weekend. What are you guys looking at? Here we got Euro.
Yeah, well, right now, we have the euro up here, and I think before we go into some of the specifics about tomorrow's CPI, you mentioned spot FX. Mm-hmm. Typically, when we're here on the platform, we're showing people the FX futures. So, for example, the 6E M5 contract's up right now. What are the big differences between, say, the FX futures contracts and the spot contracts? Spot's a lot smaller, more approachable, correct?
Yeah, it's the same underlying, so... if you're understanding kind of the fundamental factors behind it, it's easy to wrap your head around. But from an actual product perspective, I think it's a lot more approachable. Here we're looking at the regular sized euro dollar contracts, which have a really big notional value, and it's hard to scale because it scales just with that one contract. When you're trading spot FX. You can get down to, it's traded in lots, which is 100,000 of the base currency, 100,000 units of the base currency, but that scales all the way down to a micro lot. So for Euro USD, that one micro lot at 2% margin would be around $22 to enter. So, and that scales up by increments of 0.01 lots. So a lot more flexibility layering into positions while you're engaging with this, and it has the same upside of putting on those large trades like you would for micro future or even the regular futures. So you nailed it.
I can tell you for sure that when it comes to things that don't have liquid micro futures, like yen, for example, for me, spot is the way I do it. So although obviously I'll trade the micro euro, the micro pound, the Canadian dollar, the Aussie, if I want to trade the yen, if I want to trade the Kiwi dollar, which is a G10 currency and very responsive to dynamics, if I want to trade the Swiss franc, which has been very, very jumpy around all of this risk aversion and sort of sell America dynamics that we saw in April and was a great opportunity, spot is a lifesaver because you can really manage risk much better than those giant contracts that you see on the future side, which even with vertical spreads still end up being very, very large, and the swings end up being certainly a little bit more than I want to expose myself to with sort of the way that I like to manage risk. When you approach things from a macro perspective, oftentimes your timing is not what the market's timing is, and it's an iterative process to figure that out. So you might be wrong a bunch until you're right. And having small positions that are easy to manage, where you can take things off and put things on, very, very important. With spot, you have liquidity, you have smaller, more manageable size. It's very friendly.
Yeah,
at least for the way that I approach markets.
Exactly, and you bring up a great point with that liquidity. Just because these aren't piped through a CME or a centralized exchange, so these are trading 24/5. Another advantage that you probably could have gotten at this weekend, opening a full hour before the futures market. So I mean, there were still some gaps, but able to get at some of that price action an hour before futures market opens, which is
that's my favorite part about this market, by the way.
Yeah.
Like this is what Ilya and I grew up professionally grew up on.
We grew up doing this, yes.
Trading starts at 5 Eastern on Sunday. It closes at 5 Eastern on Friday. There's no batch order processing, right? There's no hour off.
Right.
There's less liquidity when things open up in Christchurch, New Zealand again, but the day is continuous, and
but it's not like you won't get a fill.
Plentiful,
right?
And that's the other side.
Yeah, okay. The spreads are a little wider, sure, but it's not like you're not going to get filled. It's not like you're sitting there on your let's say 6A option,
right,
and there's no liquidity, and you're trying to get out, and you're like, get me out of this thing. Nope,
you're in.
Sorry.
But yeah, you make a great point that in lower times of liquidity, spread will be a little bit wider. But when you're trading spot Forex here offered from TastyFX, spread is the only cost. So no commission on any of these as well, like you'd get for a futures contract. Just the compensation arrangement with TastyFX allows that to be commission free, which when you're comparing to futures contracts can add up over the long term.
They really can. I'm personally excited for spot. It's one of the reasons why I came over to futures as an interest, because it's the closest thing to the 24/5 trading environment that you have. Personally, I'm excited to see other contracts, Ilya, like the Swiss franc, like the New Zealand dollar that you mentioned. There's also a lot of the emerging market currencies, which, while not as liquid or as tight of a bid-ask spread as you'd see with some of the majors,
you can get in.
It allows you to play. You can get in now, as opposed to I have this great idea about what's happening in South Korea or Taiwan, but playing this through EWT or whatever ETF, it's not going to work because it doesn't have the prices. It's not practical. This makes it more practical. You can trade dollar mex, and you're not looking at the 6M futures contract, which is wide, it's thinly traded, and quite frankly, unless you're trading it for a small slice of the day, getting in and out of that market can be difficult at times because there's not a lot of people swimming in that pool.
And I mean, dollar is why how a lot of us get engaged with a lot of these markets, and is the most liquid of all these offerings. But there are also a lot of very popular non-dollar crosses that are a favorite for a lot of spot FX traders. So, I mean, for example, one thing I looked at this morning, I woke up and big moves around 2 a.m., of course, as you know, around all of these markets, euro dollar, pound dollar. But one really interesting thing for me to do was to check euro pound, just to get a gauge of kind of what that relative strength is, and seeing kind of validating a lot of assumptions where you can look directly at that and say, wow, yeah, the euro's getting beat up a lot more than the pound right now. And then with these spot FX markets, you're able to put that trade on just as easily. There's no math around sizing a couple futures contracts, getting double margined on a lot of those, trying to create synthetic pairs, ADFX pairs there for you for any sort of iteration that you could put a trade idea to.
Yeah, and I like the fact that you also have the Chinese yuan offshore dollar CNHs on this market. So we talk about tracking what's going on with the trade war. Mm-hmm. Forget FXI. You can just keep open your Tasty Trade platform now and look at dollar yuan spot rates around 9 Eastern every night and see how the Chinese markets open up. FX obviously is going to be something that's on our radar for tomorrow morning, though, Ilya. CPI report, something that you and I really have not talked a lot about today on either Futures Power Hour or Overtime. If you don't mind, I'm going to ask our guest, Glenn. Glenn, tomorrow we have this inflation data due out. It's typically one of the pieces of information that moves the currency a lot. Do you have any strong opinions on this particular inflation report on FX markets now that we have all this trade war news in the background?
Yeah, I mean, it's set up very nicely. I mean, it's always kind of added scrutiny on a CPI inflation print the week after a Fed announcement, especially when Fed Chair Powell just kind of pushed off a lot of rhetoric on keeping an eye on inflation. So a lot more eyeballs on this release, but then you layer into what we woke up to with the trade news, and I mean just a big run in U.S. equities, I think factors into this as well, because I think you guys touched on it earlier today of like, is this just kind of a sentiment check? Is good news taken in stride, and is bad news just brushed off? I don't think we're going to get anything ridiculous, any huge misprints. But I mean, now we have engagement back in these FX markets, volatility back up. And so any sort of misprint, you could get a little bit more of expanded ranges, which is great for intraday trading. But, we could also, given, I mean, what we're at, 3% moves in the yen already, you could start to get even another percent would be interesting for more position traders in the longer term. So the number itself, don't have any strong opinions on, but I am excited about the fact that this will be more scrutinized than maybe in previous months where the labor market was in focus.
Oh, yeah, I'm looking at the Cleveland Fed's inflation dashboard right now. Just going to pull up here on the screen. It looks like for tomorrow's report, 2.3% CPI. I know the Bloomberg consensus forecast is 2.4. You go out to May, it's 2.4%. What's in the data tomorrow that we should care about? Or is this in the tariff world that no longer exists as of yesterday afternoon?
Paused.
Well,
right.
It's not quite so clear cut as you might imagine. The scary thing in all of this, as we've been talking about, and as I've been banging on about to no end, especially today, is the idea that if the markets were afraid of tariffs conceptually, they would have freaked out at the latest in November. They were
not.
They were
once he was elected. He ran on it.
He ran on it. They should have known. They didn't do that. They freaked out in mid-February going into March, because that's when the growth hit started to appear, and that's before the reciprocal tariffs that we've now erased the impact of. That's sort of, at least in markets. That's before any of sort of the hair on fire, the dollar is having a currency crisis, and the Treasury bond is somehow not a reliable risk free asset, all of those kind of concerns. Obviously, we've undone all of those, and rightfully so. They looked overdone even just conceptually. But when you look at then the bottom line, you still have the growth scare that was there. Okay, you've had this deal. Does it change the fact that U.S. consumers are pessimistic and not spending? No. In the first quarter, what you got was the weakest consumption growth in almost 2 years. So if you look at the situation in the CPI report, the worst possible thing you could see in it is that the contribution to CPI from core services continues to deteriorate, because that tells you the one part of demand that's been relatively good since basically the middle of last year continues to come undone. This would be continued deterioration of that component. In fact, it's been deteriorating basically going back to, let's say, December. It's been getting a smaller and smaller contribution to overall CPI from 2.7 to 2.6 to 2.5 to 2.3 in the March data, percentage points of the overall. If on top of that you get a pop in the goods side, if goods inflation suddenly comes back for the first time in 9 months, that's not going to be a good mix for consumers. And then later in the week you get retail sales, and of course the University of Michigan consumer sentiment numbers, which last check put 1 year forward inflation at 6.5%. So, is anybody a happy customer out there? That's the real question here, because that's what really matters for growth. The Fed calculus has reset. The markets now see it as 50 basis points this year, 50 basis points next, right in line with what the Fed said in December and again in March, and implicitly reiterated last week. Well, the real question now is, has any of these shenanigans fixed the growth picture? And you could very easily see in the CPI report that the answer is no.
Well, I think it is very interesting that we're coming into this just from the kind of the Fed scrutiny angle, that today alone we now have traders in the futures markets looking at the CME Fed Watch tool now pricing in only 2 cuts this year, whereas the actual movement on the rate announcement was virtually nothing. I mean, taking some of the tail end out of it, but still on track for 3 rate cuts. Now, just on this tariff pause, we're back to 2.
Yeah,
I think that it's interesting to me just to note. I don't exactly know what the conclusions will be tomorrow, but was surprised to see that kind of movement just today off of that alone.
Yeah, it's an 11.4% chance of a 25 basis point rate cut next month. Only a 46.6% chance one in July. The first month where we see an excess of 50% now is September. And then maybe you get another one by the end of the year. 62% chance by October, 100% chance by December.
51 basis points priced in for this year, 52 for next. You might as well be reading it from the Fed's SCP.
I don't know. I think that's a great thing. If I'm an equity market bull, if I'm a U.S. dollar bull,
right?
I don't want the normal. Fed, I don't want the Fed cutting right now. I want to go back to the mindset of last year. Baby. I want the mindset of last year. No Fed cut because the economy's too strong. Not a problem.
Oh yeah, if you get there, man.
Well, I don't know if we're there yet, but
we're not there yet. We're very far from there.
Glenn, what do you take of all this, right? This past month and a half, like it feels like I've shaved 3 or 4 years off my life.
So you obviously don't have any crypto. I mean, that's the only reason why I keep spending is now I feel like I have a little more money.
Well, no. There's like the trader mindset versus like the investor mindset.
Right, exactly.
Right, and this is why you have different accounts. Like there's one where you just accumulate and you DCA in, and because we're not retiring tomorrow, we just add to it. And then there's the trading account, which is like, okay, that's what's
I'm never right about anything.
Yeah.
How do I get out of this? Yeah. No, one interesting thing that gets me into this week a little differently. If you can pull up the Australian dollar futures,
Sure.
that one is kind of the dollar story I'm looking at this week, because over the past month and a half, the dollar story we've been looking at, and when you get really granular in Spot FX and you don't just look at dollar basket, which weights euro obviously a lot, but you're kind of taking a look at all these the dollar against all these major currencies. What's been interesting over the past month and a half has been kind of a U.S. dollar not moving unanimously against all major currencies at once. Today was one of the fewer instances where we did start to see that converge. And the main one you look at for that is this Australian dollar, because of the risk on, risk off sentiment of this currency, that's really been taken over. Not a lot of movement with just, China trade news that you'd expect, but really just moving with U.S. equities. And this is the first kind of divergence where we've seen dollar stronger, and this dollar stronger in this Australian dollar pair with such a large equity up day, because we were at historic lows coming off of Liberation Day. And getting hammered on this kind of risk-off sentiment. And so every equity green day was a green day for this Australian dollar. Now we're kind of back in a healthier range here, and U.S. dollar moving in tandem against all of these major currencies. So this one is one that I'm going to watch this week for sure, just to see if kind of the correlation with U.S. equities comes back, or if we're behind that.
I'm long this one, actually, and it's a great case in point, Chris, for what we've been talking about. Where has this gone? It's back to the bottom of its range, but its breakout higher is holding. Same for gold. Same for stocks, although it's obviously inverted there. You're back to the starting line, but nothing is coming unglued. And so, yes, you get blistering moves in the opposite direction today. I mean, I know my ribs are going to be bruised by the end of all of this, but has it changed anything? I think we still have to wait and see, because the markets are not crossing any lines in the sand here.
Oh, for the Aussie here, if I may push back on that.
Yes,
bearish engulfing bar. We move above yesterday's high, Friday's high. We close below Friday's low, close below the 1 week and the 1 month.
And you're on the range bottom.
But yeah, this is one where you're
sitting right on it.
You have a lot of kind of factors.
Look at all these lows here, right here.
Yeah, and
we break here.
Yeah, we're not. I'm just in this one. I'm taking a lot more of a fundamental approach, just because it's so hard to see what's kind of taking over, risk on, risk off, being the main driver as of late. But is it kind of that in times of high vol, correlations go to 1? We're just bouncing off of kind of decade-long lows, and now a different kind of story can emerge, or will that continue? So I think in terms of the slate of U.S. data this week, I do agree with you guys that it'll be really interesting to see if, any of the actual, second-degree questions are asked, or if we just kind of get confirmation of, just good data this week, and no one really thinks twice about has anything fundamentally changed, or everyone's just latching on to the good for now story, or do we get something like a high CPI print that makes people question, is something fundamentally different, and kind of stop and take a breather. So big week.
Oh yeah, we're here with Glenn Freiberger from Tasty FX. He's walking us through some of the new pairs that are going to be coming onto the platform here soon. Spot FX coming to the platform. If you didn't join us at the start of this little segment here, go over to the watch list on the left side, Forex and all Forex pairs. You'll find the tickers that literally keep Ilya up at night, because he is more Spot FX than anything else, as
I am literally awake all hours of the night trying to trade the Asia into London to change. I don't remember the last time I've not done that, and of course the children do have to go to school in the morning, so sleep is not a thing for me.
But I'll get a text message sometime, be like, "Hey Chris, did you see what's happening in the Singapore dollar South African rand pair?" And I'll be like, "Ilya, it's 3:30 in the morning." Of course I have. What else would I be doing right now?
Obviously, I too am up on amounts of caffeine unhealthy for anyone but utter degenerates.
Well, you lucked out this morning. You got a good one around 2 a.m.
I made such a dumb decision the other day. I usually have this like lemon tea, cayenne pepper thing in the morning to like wake up the body. And I didn't do it the other day. So I said, you know what, I'll have it in the afternoon. And instead of putting in like a quarter teaspoon of cayenne pepper, I put in a teaspoon of cayenne pepper. So this thing is making me, I take like one, I'm hot. So I grab my iced coffee and chug down the iced coffee. All of a sudden now I have like this, it's now 5:30 and I didn't go to sleep until like 4 o'clock the next day. In any event, Ilya, let's wrap things up here. Tomorrow we have CPI
for me.
retail sales later this week. The earnings calendar is obviously a little bit lighter. So macros in focus here.
Yes.
Let's just benchmark the trade war stuff as we kind of exit this conversation for today. There's now a 90-day pause. We have the 90-day pause with other countries, with China. The EU obviously still needs to be accomplished. What's the risk this week? What's the risk in the data?
The risk in the data, in my mind, and the indicator that we like to watch for this is the Citigroup Surprise Index that gives you a sense of whether data in aggregate is beating or undershooting expectations, that the data is weaker. And that what that weaker data tells you is that the underlying economy, beyond all these shenanigans, the deal is on, the deal is off, the tariff is this, the tariff is that, that's the problem to begin with. That it is so volatile, that it is so uncertain, and that businesses and consumers have pulled back spending because they don't know what's occurring. And what is said today may be very different from what is said tomorrow or the day after. So yes, the markets cheer this, of course. But it makes sense that they do. But if you get the underlying economy telling you, good, you had yourself a nice news cycle, meanwhile, the people actually interacting with the real economy are pulling back, well, then you have a problem on your hands that has nothing to do with any of this noise. And, I would argue that's been the problem all along. And the noise is irrelevant.
Oh, would you argue that?
I think I might.
Glenn, take us out here. What are your? It's nice to have you on, by the way, for the first time. Hopefully
Thank
that you come back again soon.
Let's do it.
Will the Knicks be down 20 points tonight before they come back, or can we just have a normal game?
I think everyone take a break. We'll wake up where we are. Nice, easy aftermarket. Let's do it.
All right, let's do this aftermarket. Ilya, you're on next. Macro Money's coming up here, but we're done. Thanks, everyone, for tuning into this bifurcated overtime today. We had special guest Glenn Freiberger on from Tasty FX to walk us through some new features on the platform. Likewise, chop it up here, talking spot FX and the dollar. So for Glenn Freiberger in Chicago and Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Thanks for joining us. See you tomorrow. Until then, good luck trading. Stick around, though. Macro Money is up next here on Tasty Live.
See you there, everybody.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
I distinctly remember getting an email from Tasty that Lookback had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was, and basically instantaneously, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring, and then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from tastylive to look at that. And that's when my consistency went from like 1 to 30, and I haven't had an unprofitable quarter since.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Well, the markets certainly liked the weekend news flow. U.S. and China try to walk back the meat of the trade war, and traders certainly are applauding as they do. But are we through the worst, and are we on the other side? This is the key question now in front of markets. And without any ado, we're going to jump right in and take a look at what comes next. There is a bevy of macro event risk this week to inform precisely that question. And we'll get right into it here and see if, in fact, we can finally put a pin in this trade war and say, well, everything is back to normal and we are going down a better path. Here's a quick look at the performance across the major markets last week. We can see equities stalled. The bond market saw a slight increase in yields. The U.S. dollar strengthened a touch against that backdrop, up about 0.4% against the euro, 0.2% against the yen. Crude oil had a nice little pop around all manner of cross currents, as ever, walking to the beat of its own drum. Gold prices bounced a bit, but of course that story has significantly changed now. At the open of this week, a lot of these moves looking very different, and of course the standstill in stocks in particular in a very different sort of setting here. And this helpful chart from the Wall Street Journal just helps to really highlight the dynamics of what's occurred. So we have a sharp spike right at the weekly trading open, and it follows news that after 2 days of talks in Geneva, Switzerland. Treasury Secretary Scott Bessent, U.S. Trade Representative Jameson Greer, and their counterparts from China reached some sort of epic breakthrough in negotiations. Apparently, all that was needed was for people to sit across the table from each other, for there to be a sudden epiphany of understanding. The president commenting on Truth Social over the weekend that this has been a total reset, quote unquote, of relations with China. So what has actually occurred? Well, we have a pause of 90 days on tariffs above 10%, with a carve out for those tariffs that target a sort of more punitive line around the export of fentanyl precursor chemicals from China, and a desire from Washington for China to battle that more vigorously. So we go down on net from 145% levy rates U.S. against China down to 30. That's a baseline of 10, the same one that was baked into the trade deal with the UK last week, and the same one that was announced as the new floor on quote-unquote Liberation Day. And there's that additional 20% of carve-out tariffs. For China, we come down from 125% down to that 10. So obviously much, much, much lower tariffs than were there when the trading session closed on Friday, and obviously the markets love to see it. In addition to these dramatic moves in stocks, which end up giving us a gain of 3.3% on the S&P, 4.07%, almost 4.1% on the NASDAQ, 3.6% on the Russell. We get a dramatic shift lower in the bonds across maturities, down 0.25% on the 2-year, but down 0.6% on the 10-year, and down almost 0.75% on the 30-year. The gold picture much weaker. That's down 2.7% today. Dollar up about a percentage point against an average of its major counterparts. So a broad-based unclenching around the markets. But looking at the S&P 500 here as a kind of bellwether asset for risk sentiment, one does begin to ask, why stop here? This is a very interesting point here, as a matter of fact, for the S&P 500. We can see here that we establish a kind of consolidation range from early December into about the middle of February, and we test the bottom of this range continuously. This is where the markets are sort of waiting to see, as it were, what the new administration will do. There's obviously a blistering rally into this range, but as the year begins to wind down and we begin to turn in the direction of what the new administration might do, and of course the end of year dynamics more broadly, the markets settle into this range, and it is mid-February when they start to roll over, and going into March when they really break the range and establish that what began here was not just another pullback in the range, like this, say, but rather a more concerted breakdown. We, of course, bounce off the lows just above 5,500 there that we find in mid-March and consolidate right up until we get into Liberation Day, where we get our hair on fire moment here as the markets contemplate the possibility that the U.S. is looking to extricate itself from its role as the global reserve currency, as the risk-free asset of choice, and what that might mean more generally for a financial system that is absolutely dependent on those two things existing and holding. And so we've come all the way back to erase that scare, and with this pop today, we come back to the starting line of the bearish breakdown as a whole. The question now is, of course, why do we stop right here? Why don't we keep going? And what does it mean to have come back and stopped at exactly this spot? So you come back to the realization that if the markets were afraid of tariffs as a general concept, then this sell-off would not have started here. It would have started here, back in November, when the outcome of the election became certain. Because, of course, at the time, candidate Trump had spoken extensively about tariffs, and anybody with ears and eyes over the preceding months might have known that this was coming in some shape or form. Instead, the markets rallied. They rallied because they reasoned that the tariff story would be about as flimsy as it was during the first Trump administration, where there were tariffs, and really they were just onboarding tactics for trade negotiations, the transformation of NAFTA into a nearly identical USMCA that ultimately just gave us freer trade by expanding the agreement and didn't actually do much else. That looked to be the framework. Meanwhile, people looked ahead to tax cuts, they looked ahead to deregulation, all of which was seen as probably going to juice up growth, at least in the near term. So the tariffs were not a source of fear when they were obviously going to happen to some extent. They became a source of fear here. Well, what changed here was the tone of the economic data, which signaled that the rollout of the tariffs at that point with Canada and Mexico, as it presented itself, was enough of a concern for businesses and consumers that they stopped and looked around and said, you know what? We're going to wind back spending. We're going to wind back investment. We're going to wait until the dust settles. Because for now, the fog is too thick. And that was a very significant dampener on economic activity. This was, again, before any of the reciprocal tariffs, before anything that we now, in the wake of this dramatic rally off April lows, can say has been digested, priced in, and perhaps moved on from. We'll see in 90 days if that part holds. But all of that aside, we are back to the point where the markets decided that what's coming is some sort of an economic downturn because uncertainty has put the brakes on spending. We can see from the latest survey data here released over the past several weeks exactly what is at work. These are the numbers that kick us off. We see that after nearly 6 months of very strong U.S. growth, in fact, by the end of last year, the strongest in almost 2 years. In fact, a little bit over if we look at the sort of totality of what's going on here. We get this sharp deceleration just as the year begins. And we can see, of course, as ever in the logic of PMIs, where 50 is neutral, above 50 is growth, and below 50 is contraction, that we come down from these higher levels of growth. The higher you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We find that growth on this composite index that subsumes services and manufacturing, we go from these heady levels to essentially standstill. And in the most recent data, even further that way. In fact, we get the weakest growth in 17 months. It's a similar situation for the ISM survey, a different view of similar data. And here you get slightly stronger services than you do in the S&P Global version, but you get slightly weaker manufacturing than you do in that version. But when you look at what it all boils down to, it's a coordinated slowdown in both services and manufacturing since the beginning of the year, and a relative netting out, again, just a hair above the 50 line once you consider that services is a bigger part of whatever average you might construct here than manufacturing, because it's just a bigger part of the economy. So you get a sense that you're biased a little bit north of 50, but only just. And so either way you slice it, you're back to effectively standstill as far as this survey data is concerned. Now, you seem to get confirmation of a slowdown in the latest set of first quarter GDP numbers, but of course, as we've discussed here in detail and as has been covered extensively elsewhere, there is a massive distortion here from the tariffs. Even the Fed name checks these distortions in last week's policy announcement. So perhaps once those distortions are out of the way, then everything is okay. And indeed, we do have a historic walking back of risk to the economy with this U.S.-China de-escalation. But maybe not so fast. Here's the breakdown of GDP, and indeed we find that we have dramatic distortions in the data. The negative number on overall GDP almost certainly impacted dramatically by this near 40% surge in imports. Of course, as people look ahead to tariffs and front load as much as they can before those tariffs hit. Again, this is the first quarter. This is through March. The reciprocal tariffs are not a thing at this point. This is just the markets and businesses knowing that the administration wants to do tariffs and trying to anticipate that by buying as much as they can offshore and getting it into inventories before tariff rates go up. So of course you get this surge in inventories, which are a part of this investment component here. You get a surge in imports, which dramatically undermines the overall GDP numbers. If you stripped this out and you stripped this out, you'd be left with a much more normal picture. But the real bit here that bears paying attention to isn't any of this at all. Take away all of this, and this component here, consumption, is the weakest it has been since back here, the second quarter of 2023. So we're looking at the weakest consumption levels, or the weakest consumption growth, in close to 2 years. And it is, in fact, this part that matters. Because consumption makes up 68.5% of GDP in this latest data set, as it tends to do. It tends to oscillate somewhere around the 70% mark. Whereas the external sector only amounts to, once you net out exports and imports, something on the order of 4.5–5% of the overall picture. So the question beyond the trade deal here is what happens next, and whether the real reason that the markets were concerned to begin with before the escalation, which you can see right here, was the growth concern, and whether that growth concern has been undone by this apparent walking back of the worst of the trade war chaos. And on that score, we have ample data this week to try to make a decision, starting, of course, with U.S. CPI figures. Here, we are looking for standstill. The core rate expected to remain unchanged at 2.8%. That's excluding food and energy. The headline expected to remain unchanged, likewise at 2.4%. But it's really the makeup of these numbers that matters most. The market is back to pricing Fed policy exactly as Fed officials envisioned it in December and in March. 50 basis points in cuts this year, 50 basis points in cuts next year. So whatever panicky reason there was for the markets to think the Fed would go faster, they've been unwound. And the Fed has very clearly said, look, we don't know which way to go here. We heard from the Fed just last week. And they told us, look, we don't know which part of the mandate to prioritize. Now, if the tariffs have in fact been put back into a box to a large extent, despite the fact, of course, that if the floor really is 10%, and before these latest hikes, the average U.S. tariff was 2%, then the price of imports for consumers still have gone up 5-fold. But perhaps that is digestible. We'll have to see. Nevertheless, consumers still face precisely the same calculus. And so if we have a situation here where goods inflation, which we can see here is barely an afterthought in the most recent numbers, if that starts to increase in this April data, at the same time as the service sector, this big bit right here, starts to see cooling inflation continue. In fact, we ended up in the most recent data in March with the slowest service sector inflation that we have seen since back in December of 2021, telling us that the pull from demand is weakening. And of course, we just saw with these PMI numbers and these, the service sector is where demand has lived in the U.S. If service side inflation is cooling, that tells you that the pull from demand there is unraveling. And if at the same time that gives us a pop in goods inflation around this 5-fold increase in duties, again, best case scenario, well, then consumers aren't going to be very happy. And they're probably not going to be enthusiastic about rebuilding consumption from here to levels more familiar with where growth was much more robust. Later in the week, we get U.S. retail sales data, expectation that retail sales stalled in April after this 1.5% surge in March. Again, consumers seemingly front-running the tariffs as well, and that now expected to have run its course. The year-on-year rate expected to come down to 1.1%. If we consider sort of where that puts us in the relative history, it is hardly encouraging. This would be the slowest that we've seen for retail sales growth since January of 2024 in year-on-year terms, and indeed one of the weakest numbers that we'd seen since before COVID. In fact, the January of 2024 number was only 0.3%, and that was something of an anomaly. To get anywhere like this 1.1% expectation, we have to go all the way back to mid-2023, and it'd be an anomaly then. As a matter of fact, you'd have to come back to pre-COVID retail sales growth to get somewhere in the vicinity of what this would look like. And so, with that in mind, you have yet another window here for the consumers to show you just how willing they are to buy the optimism. And of course, at the end of the week, we get an even clearer picture, an update from the University of Michigan on their very closely watched consumer confidence survey. Obviously, all of this talk of tariffs has absolutely cratered confidence, and that's as we've seen a sharp rise in consumer inflation expectations. So a surge here to 6.5% inflation, higher than at the peak in 2021 going into 2022. So consumers are plainly unhappy here. And if none of what's happened here changes that basic baseline, and indeed, U.S. economic data has tended to disappoint relative to forecasts, as we see on this Citigroup index still hovering below zero, well, then this component to overall growth is hardly fixed. And this is the one that matters. All of this noise notwithstanding. So if in fact all of this back and forth has failed to give consumers the kind of confidence to bring them back in force, well then all of this inventory buildup is for naught because there's not anybody to sell it to. And perhaps the situation is even worse than it was before because whereas businesses did not have huge fixed inventory costs before this episode, if consumers end up not buying this inventory at the speed that businesses might hope, or even at the pace that was there before, again, looking at this year-on-year retail sales line here, we can see that from early 2024, the pace has been slowly creeping higher until this most recent drop-off. So if we get then the sense that consumers are not any happier, that demand is not any stronger, and that the march toward recession continues, well then this becomes a very auspicious place to stop indeed. Because this becomes the place where the handoff from the hair on fire portion of the story back to the recession portion occurs right in the spot where you'd expect it, not in a way that is favorable for continuation of this risk on build. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dewitt Radigan, looking at the Wall Street close and where things may go from there. I'm on with Chris for Futures Power Hour, Mondays and Fridays. On with Victor Jones for The Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day. Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, of course, it's Monday. The one, the only, Katie McGarrigle in the house. Katie, how are you? How was your weekend?
I'm good. Weekend was pretty good. We're slowly creeping into actual springtime weather. Seemed like there was a lot of people out yesterday. Yourself included, myself included.
Enjoying a little Mother's Day action? Yeah.
Yeah. Mostly just around the neighborhood. But Randolph was popping. It's a good time.
Yeah, people will say this about the Chicago weather where you really only have 2 seasons. And I do believe that's true because it's going to be 90 degrees on Friday. So you go from like 40 to 90 and then boom.
Great day for the Crosstown Classic.
Oh, that's right.
I believe it's Cubs Sox on Friday.
You're right, yeah.
You a Cubs fan or Sox fan?
I am probably more of a Cubs fan. I'm a Yankees fan.
Okay.
So bring on the hate. But yeah, more of a Cubs fan.
Okay, fair enough.
I like them both, though. Can I like them both? Is that possible?
Yes, of course it is. You can just be, team Chicago.
Team Chicago, yeah.
Because, we sponsor, Tasty Trade, I should say, sponsors the Cubs. But I'm Southside Irish, so I'm a Sox fan by birth. But,
You're born
to go to a game no matter
born that
what.
way.
Yeah. I mean, I think the food is better at Comiskey.
Yes, absolutely.
But, there is something about the old school vibe at Wrigley.
Yeah.
So, anywho, so what else have we been doing? Oh, so you and I have actually spent a little bit of time today together because we're going on the road this year.
Yeah.
tastylive.com/events.
In person,
talking about trading and portfolio management and trade management. So if you have not signed up, we're doing DC, Seattle, San Diego, and Dallas. I know a couple of your dates are TBD, but you're definitely in DC, which is our first one kicking off just about a month from now.
Yeah, we're first week, second week in June?
Yeah.
In DC?
Yeah.
Yeah, I want to do all the shows, but my wife said I'm not allowed.
Maybe you need to talk to her about that.
What the hell?
I'm joking. But yes, Thursday, June 12th at 6 p.m. Eastern. So it's going to be an evening show. So, tell your boss you're leaving a little bit early. Come hang out with us in DC. You can sign up at tastylive.com/events. These are going to be smaller shows. So hopefully you'll get to mingle and chat with everybody a little bit more and maybe make some friends there. Everybody likes more friends.
Yeah.
And there will be libations, which is probably the best part. If you're not coming for the trading content,
come for the booze.
Come for the booze.
Yeah.
Exactly.
I'm looking forward to it. Looking forward to going on the road with you and Mike and Nick and talking markets, portfolio management, crypto from my side of things. So
Yeah, it'll be good.
Yeah.
I think, we've been talking a lot about me and you as an audience, right? Like, and we started doing, stocks and options when we were first doing our trading journeys, which is such an overplayed phrase. But, you've in the past year started to really kind of get me into this crypto space. And now I see how compelling it is to really truly start to integrate it into your portfolio, and how you don't have to take a giant slice of the pie for just crypto. And there's a small way to integrate it and give you that exposure. So hopefully we can impart some of that knowledge on other people.
Yeah, a little crypto goes a long way.
Yeah, for
Or
sure.
it can.
I mean, I was getting notifications all weekend Solana just hit 30-day high and Bitcoin just, breached 105,000. So eager to kind of hear, what your impression was of the activity late last week, this weekend, and kind of how you're positioning yourself and what you're thinking about.
Yeah, let's do that. Let's jump into the show. But actually, Katie, before we do, if you're not on the chat,
what are you doing?
Yeah, what the hell? Get over to YouTube. We're streaming live chat. You want to make some friends? I want to make some friends. It's good to have friends, right? You might be able to make some in this chat. We'll see if everyone plays nicely. But we got Lone Sofo, Sub-Zero, Kimberly Thomas. What's up? The gang's all here, Katie.
Yeah, it's going to be great.
Yeah, get over to the chat. Just say hi to Katie, I guess, or type some crazy shit in the chat. I don't know. Whatever you want to do. Let's jump into our slides. I put this together earlier this morning. We talked about this on Options Trading Concepts Live. So the numbers are slightly stale. I got a Bitcoin price of 102.5, but when we put this together, we had 103.2. But yeah, seeing a continuation of the rally that we saw towards the end of last week here, a bit of follow through. So on a 1 week basis, everything is up in the green for the most part, though some of those laggards where we saw that Bitcoin outperformance for really most of this year, you're seeing a bit of a bounce in ETH, seeing a big bounce in Doge all of a sudden. Solana is doing well. We've talked about SWI, XRP is up there. So you can see over the last week, really over the last month, it's been trading a hell of a lot better than how we started to trade at the beginning of April, but really more so since February. You saw that kind of, post-election high, and then markets have traded sideways to down in crypto since then and accelerated to the downside post the tariff announcement at the beginning of April. But I've really recovered all of that and more here.
Yeah, definitely. Where's my bonk at? Is the real question.
Yeah, we don't offer that through Tasty Trade just yet, but that is a meme.
It's a residual
on
bag
Solana
that I've been holding.
Okay. Nothing wrong with that. I'm sure it's up a bit. Let me actually take a look and see where bonk is at the moment.
But no, you're right. It's been nice to kind of see a little bit of.
Bonk's looking stronger.
Okay.
Yeah.
I'll take it. No, but it has been nice to kind of see a little bit of a bounce. And I'm sure everybody's portfolio, whether you did have stocks or options or other things, if you had any type of long delta, I'm sure today helped you out. But it is nice to kind of see Ethereum, especially when you had just talked about last week layering in a little bit more as Ethereum went under, 1,800, 1,750 or so. And now we're at, 2,500. Not too shabby.
Yeah, up about 60% in the last month, which is a heck of a move. Not quite bonk, which is up about 80% in the last month or so.
I mean, the more volatile, I guess that's like something that we've talked about too in the early days of doing the show together, is some of these more established coins, even though they are still a high volatility product relative to some of the other things that we often trade and integrate into our portfolio, some of these smaller coins, they're, just extremely volatile because there's no duration and long-term authority of having them be like these, looked at as these very stable.
Yeah, absolutely. Small, tiny micro cap tokens here can move 80% one way or the other in a matter of weeks.
Going tripling or going to zero,
which I think there's a place for that in your portfolio.
Totally. As an engagement play.
Well, even given that you have this asymmetry, right? So no one is going to advocate that you should put a ton of money into it, but you have a position where historically these things can 5x, 10x, or they can go to zero. There's no denying that a lot of times they just go to zero, but maybe there is a place for that kind of asymmetry, that optionality, right? It's similar to just being long a call option. A lot of those far out of the money call options are likely to expire worthless, but here you don't have the time decay. You just have the potential upside, or you have, a lot of downside risk. But if you're comfortable with a very small position, sometimes that pays off. Timing is everything, which is always going to be true in markets. But if you were able to kind of patiently step into this after the destruction was done, you can catch some of these big moves. And if you did, you're feeling pretty good today. I think the key is to not get too greedy, and you want to take a little bit of money off of the table at times. You might miss a much bigger move, and you kick yourself kind of, in hindsight. But look, if you were trading ETH at 1,500, 1,600, it was there for a second. But let's say more so, we're chopping it around 1,700, 1,800 here, and you just got a very quick move up to 2,500. Might be prudent to take a little bit off the table. One thing that I will point out is that you are seeing, a little bit more strength, relatively speaking, still in Bitcoin, in XRP here. That shifted pretty quickly. But that momentum that we like to track on a weekly basis and a monthly basis is not as strong for ETH, even though you had a heck of a bounce here. You still haven't structurally seen, much of a shift. We're still down 35% year to date versus Bitcoin, still down 6% in the last 3 months. So there's not an extremely bullish trend in there, or a strong trend is probably more applicable. Maybe you see that show up, but it still has been, a story of Bitcoin market cap dominance, relative outperformance, and you're still seeing that here today.
Yeah. So with that said, did you do anything over the weekend? Have you participated in anything, today prior to the show, or on the show with the guys earlier today?
Earlier today, before, not on the show, and I've been trying to push this out on the follow page. We had it all wired up, and it gave me a message that it was successful, but I didn't see anything actually go out. I was selling a little bit of ETH that I bought at those levels. With my luck, I will probably just watch this run to 3,000 and was early on a sale. But
I'm the reverse indicator here, not you.
Okay, well, I got to watch what you're doing then. But just taking a little bit off the table, and I think you're going to see some chop here. I wouldn't be surprised at all. We'll go through the expected moves in just a second. Wouldn't be surprised to see Bitcoin pull back, even if it's just for a moment, underneath 100,000. So if you get that, I think it's an opportunity within the bull trend to add back to it. But I think like anything else, you want to trade around in here and manage risk by taking some off at the top of that range. The larger Bitcoin range is 75 to 110, so you're certainly much closer to 110 at this stage.
That brings up a really good point and question that I think we've talked about a little bit, in the past as well, which is, I've told you this a million times. I love when you show like the daily, weekly, monthly expected moves in like a dollar amount. Thank you.
Boom.
So stunning. But when you look at this, and you see that plus or minus, let's just call it 6,600 number. Something that I used to do a lot with Pete and Frank when I was first learning how to do futures was taking those expected moves based on, recent historical ranges, and then saying, okay, let's go 50% of that to 30% of that would be my ideal profit target for that window of time. So, in this instance, let's just say I'd be happy to squeeze out $2,500. Would you say that would be a realistic, because it's a static asset, where it's not 50% of the total credit received. Do you have a rule of thumb for how much you kind of tend to cover in terms of looking at this range and expected move and then paring it down to some type of fraction of that in terms of your P&L target?
Not exactly, given that this can move so much. And I would even argue or caution that vol is low in here. So the prices that are derived from that implied volatility, I think, are historically low. Doesn't mean that they have to go up. But when you look at what is happening in terms of realized volatility, and then where you also are from an IV rank perspective, we're at a 3-month IV rank of 11, a 10 on the 1 year, 7 on the 6 month, a little bit higher IV for ETH. I just think you could see much, much bigger moves than this. So I would trade the range itself on a 1 week basis. But there's nothing wrong at all with just saying, okay, I'm going to get into this at 102, and if it trades to 105, I'm going to take a profit.
Yeah.
It's a decent move. That said, when you look at the underlying percentage move here, so if we're pricing in 6,500, just to make the math really simple, I mean, we're looking at like a 6%-ish move here. Bitcoin's up almost 9% in the last week. We know that it can move 20% in a week. And so I would just, again, caution that vol is pretty low, and you could see much higher levels of volatility materialize pretty quickly.
Yeah.
So something to be aware of. But that's how I also think about it. Instead of just looking at the dollar move and saying, okay, we could get a $6,000 move in Bitcoin. What is that expected move on a one standard deviation, 1 week basis? What is that in percentage terms relative to the underlying price? Is it 5%? Is it 6%? Is it 10%? And you can kind of get a sense then of, if that's expensive or cheap versus, well, what is it actually doing, right? So we start to look at implied versus realized.
Okay, fair enough. That's a great, response. And I think we talk about that a lot too when it comes to like earnings announcements and expected moves, where maybe Mike, Nick, and I will get a suggestion from the chat, like, go take a look at this one. And it feels as though the expected move that might be being priced in on like the Thursday afternoon is like lower than we were anticipating. So we'll, naturally default to doing like a wider strategy, a wider iron condor or something like that, because we feel like the volatility is kind of under baked in, if you will.
Yeah, I don't disagree at all with trying to take, profits more quickly in here. I guess the way that I think about it too is that it depends on the product that you're using. So if I'm trading Bitcoin futures and I have embedded leverage, then I might be much quicker to take a profit versus long some Bitcoin spot. I mean, I'm looking for a 5% move. Well, that's going to be a price back up towards, if we just again use about 100,000, it's going to be about 105, 106 from where we are.
Yeah. And full disclosure, I mean, you're spot on. Like even since starting the show with you in late October, I've barely pulled anything off of the positions in crypto that I've been building, purely because I'm buying them and I'm getting in at small enough entry prices that I feel kind of comfortable holding that. Like, I didn't just put 20 grand in one position at one price. Like, I've been slowly kind of chipping away a couple $100 here, a couple $100 there. And so therefore I feel like I'm able to weather, some sideways grinds to slightly downward grinds, and not be necessarily pulling off a ton. And it's funny to see my brain changing from the 45-day options trading window to actually having this more of an investor mindset in this space.
Yeah, I think with some of this, with Bitcoin and maybe ETH, you're going to get paid the more patient you are typically, right? If you're able to just buy this, put it away, you have it as part of your portfolio allocation, use it as a diversifying agent. We've talked about the asymmetry that exists at times. You're probably going to have more success. I mean, historically, this has been true, just buying and holding this and then taking some off at the top of these much larger ranges, right? So if you can be patient enough to wait until you inevitably get back down to, let's throw out arbitrary levels here, but 80, 90, and then you're patient enough to wait to sell it when it's at 110, 120. Mm-hmm. I think that to me is easier almost than trying to pick spots in here with no leverage on a much more frequent basis. Now, that said, if you're in something let's look at a few of the other alts that we have here. Let's say you're in SWE. Now, this is trading at 122% annualized 30-day realized volatility. Or you're in Aave. You're seeing these things move around, $200 underlying. It's going to move around $20, $30 in a week.
Right.
Then you might be more likely to take profits more quickly in there versus Bitcoin just doesn't have the same volatility. Maybe is one way to look at it. You might trade Doge a lot differently than you would trade Bitcoin or ETH.
Yeah.
You might trade ETH a lot differently than you trade Bitcoin.
Totally. Yeah. And actually somebody just raised something very interesting in the chat that I also recently just saw. So Laidback Trader saying Coinbase is joining the S&P 500. I also saw that news.
Nice. I didn't see that. So
coming out. I don't know. I'm trying to see if I can verify it on any of these sites. but it's looking like it's up $20 after market close.
There you go.
Replacing Discover Financial, yeah, confirmed on CNBC. Jumped 8% in extended trading hours.
Okay. Yeah, I've got it at 226 right now off of a 207 close. So post market. That's another one though, where that's exciting news. But we're talking about a stock that was $350 just a couple of months ago.
True.
And has the potential to get right back up there. Also has the potential to go down another 50 points. So with some of this stuff, I think you've got to almost be in it for the larger moves.
Yeah.
Right? Don't get me wrong. There's nothing wrong with making money. But what I've learned in here is that you really want to kind of ride that trend because these things just extend. And they can do that for months at a time. And then hopefully you can get out when it's a little overextended. But they truly trend. Or when you notice that, like, okay, ignition, blast off, right? Like, ride it. Or see how long you can ride it for versus just kind of more intraday trading or choppier trading in there.
So you don't really necessarily feel like right now, particularly because we're just now broaching levels in, let's just call it Bitcoin, that we were seeing in late 2025, that we are overextended. Are any of these coins right now feeling overextended to you?
No, I don't think so. I mean, look, if you were in the market at $75,000 Bitcoin and you have it back at 100, maybe it's prudent to take a little bit of money off the table and you look to buy some back if it dips again. But in my own personal opinion, I think that you're going to go a lot higher here. I think the conditions are ripe for that. I think this is a 3 to 6 month sort of trade. Where could you be if it all plays out? A little bit more conducive macro environment seems to be where we're headed. We just came out of a pretty violent and volatile period. And we're back near all-time highs. I think ultimately, we have to watch and see if this is true. But if you break that 110, I think it's off to the races. And maybe you get to 120, 125, 150. I don't know. I've been in this for a long time. I've seen some really crazy shit. I have made a lot of mistakes, and I know what this can do. And it can become a lot more irrational than you might think. And so I wouldn't at all be surprised to see this run, if only for a moment, to 200,000, to some, think about whatever the crazy number is. I talked about this earlier today, but you've got a $100,000 underlying that has a 50% realized volatility on a 1 year basis. So it's one standard deviation move on a 1 year period is either 50 grand to the downside or 150 to the upside. Well, I think we're back on that track to go to the upside. So that's what I would play for in here. Honestly, try to hit more home runs in crypto than I do in other products.
Swinging for the fences. I like it.
Because you get those kind of fat pitches, if that makes sense.
Yeah.
This thing moves around a lot more.
So with that said, I know that I asked you a couple weeks ago, what are you doing or are you doing anything in liquidity pools? And I think you said to me at the time that you were kind of priced out at the moment. Did you take a look at any of that this weekend?
Yeah.
Do you feel like when we breach this 100,000 level that more people are primed to participate? What is your observation?
Oh yeah, this pulls people back in. I mean, this market is back alive. It was never dead, but definitely feels a lot better. People get excited again. You're $25,000 off of the most recent low. So when you look at ETH, I mean, ETH just made a 60% move. If we go back to 61% move in the last month. 40% in a week is going to get your attention regardless of what the token is.
Yeah.
When it's one of the second or third largest by market cap, it really piques people's interest. And you've got pools that are now really starting to generate pretty decent annualized returns again. So I'm back in it. I have a couple of my pools that I just had, at higher prices that are now back in range. So that feels much better. You want to manage that appropriately. I try to, when I get out of those pools, put a little bit of money on the side. So if I generate a profit on the underlying collateral, I won't put it all back into the pool. That's one way that I'll manage risk in there. But yeah, that trade's back on.
What are your favorite pairs again for those pools?
I only really ever do ETH USDC.
Okay.
On Base, on Uniswap. Been doing a little bit more on the Unichain. That's Uniswap's L2. They have rewards right now, so they boost or juice your liquidity pool. You get Uniswap tokens. So extra little kind of dividend, I suppose.
Do they have like little confetti that pops out too?
I wish, yeah. But it's an incentive mechanism to try to bring liquidity into different pools, and you see that move around at times. But that's all I've been doing. I've been trading a little bit of IBIT. I'm not selling premium in there.
Just buying some out of the money calls?
Yeah, I own longer dated out of the money stuff.
We talked
for the leverage.
Yeah, you had a couple of like year plus ones on, right? Or
Yeah,
late
well,
December?
like 180 day, 150 days, somewhere
Maybe
around
it was
there.
like later this year, maybe.
Yeah, I have a hard time selling puts in there because the vol is so low. And it could go lower, but that's just one thing to be conscious of. You got an implied volatility of 46% for Bitcoin and about the same thing for IBIT. Yeah. So it's cheaper. I want to sell something that's a little bit more expensive. So I'm just a buyer of calls right now.
Okay, so buying some calls, later dated, like 30 delta, 10 delta?
Well, I'd have to double check and take a look. Let me see. I can tell you exactly what I'm in one moment. I have, where are we here? Apologies if I can find it on my screen. I got the 70 and 75 call that I bought a couple of weeks ago.
Yeah, so a couple of different, price points, 30, 40 deltas, something like that.
Yeah, I probably started at like a 20 delta, and it's moved up a little bit. But yeah, the whole idea there is just simply that the upside volatility is cheap relative to where I think it could go, right? I have to have a thesis that's at play here, which is I just want to own and have that optionality to the upside in the event that you just see something crazy in here. Doesn't mean that it's going to happen, but the way that this is trading, it's certainly a lot more bullish. I think there's structural reasons that support this. I mean, you can look at the ETF flows as one example of that. You see a world that's moving away from very, very slowly, but moving towards diversifying against entirely dollar-based collateral. Bitcoin, gold, all play a role in that. I know gold was pretty volatile here today, but it's coming off of all-time highs. And yeah, I think that you could very quickly, just given how this can move, see a Bitcoin price 125, 150, might not stay there, but I want to own that upside optionality.
Yeah. And I think that's like the name of the game, right? Is you can't profit if you don't participate. But you need to make sure you're participating in a way that is in line with your size and your risk tolerance and your goals. So
yes. Yeah, you're not, in my opinion, going to want to come in here and load up on, a 150 vol altcoin. That could make it for you. It could also break it for you. I would prefer to, kind of trade this a little bit differently and still stick with primarily Bitcoin.
Beautiful. Anything else on your mind? 1 minute to go?
No, I just think, look, we're entering into a macro environment that's going to be a lot more conducive to economic growth globally. This is not something that, as a U.S. investor, you can just take a U.S.-centric view. You have to look at the bigger picture. I think that we've shown at times, and many people have done work around this, this is largely a function of global liquidity. So you can see on X or on Twitter, all the charts going around showing how crypto or Bitcoin prices lag global M2 or money supply by roughly 90 days or a few months. And you are seeing a complete shift from what the liquidity environment looked like in the fourth quarter of last year, what we just went through on a lag in the first quarter of this year. You had a bit of a growth scare. You saw that in terms of how a lot of this stuff started to trade in February. And everybody thinks this has something to do with tariffs. I don't think so.
Okay.
I think that's a distraction here. Sure, a bit of a relief rally today on news over the weekend that was already being priced in at the end of last week. I think this is a function of liquidity. Liquidity is about to get a lot better. Economic growth is about to pick up versus where we've come from. And I think it's a setup where you could see much higher prices. Now, it's not going to stay there forever. You have to trade it accordingly, but that's the environment we're heading into, in my opinion. If we have evidence that changes, we'll let you know, but everything just signaled, you might be in blast-off mode, Katie.
You heard it here first.
That's right. That's going to do it for our show. Thanks for letting me just pontificate.
Gonna run that tape back at some point.
And yell about this, when it goes down and corrects another 30%. But that's one more thing I'll just add really quickly. in bull markets, in Bitcoin, historically, we don't have a ton of data, but you got almost 20 years, not quite. You often get a series of 25 to 30%, a little bit more pullbacks. That's what you just got. It wasn't the end of the bull market by any means. And I think, we come out of the other side of that. And in the short term to intermediate term here, you have an opportunity for much higher prices. It doesn't mean that look, it's 102,000. I think it could easily trade back to 90 on its way to 150 is how I would look at this.
Beautiful.
So that's going to do it for our show. Katie, thanks for joining me. And again, just let me kind of yell at you here
It's
on the
fun.
show. So,
I enjoy it.
well, I appreciate it. We will be off on Wednesday. We're headed to Toronto for the Consensus, the CoinDesk Consensus Conference. But we'll be back the following Monday. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah. It is Monday, May 12th, a little bit after 5 p.m. Central Time, the best time. You know what that means, everybody. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And good God, could there be any other day where it pays to explore the incentives and not the news articles, the incentives and not the pundits, the incentives and not the rhetoric than today. More on that in just a bit. Before we get there, let's say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of the conversation, there's only one place you can do it, and that's boom, somewhere over on Tasty Live's YouTube channel. So subscribe to the channel so you can get your thoughts, both appropriate and inappropriate, on the screen here. Shout out to everybody that's already in there. I will take a moment to shout out to everybody. Kimberly Thomas, how are you? Lone, Soul Train, Katan, how are you? Jay, everybody else in the chat, I see you. Hope you had Emmett says LFG, it's Victor time. You know, I wish all of you could have a moment where you just get a group of people that just say something like that when you start your job. When you start your job, you get a couple of people that just cheer you on and get you amped up. Emmett, you did me a solid just now. Thank you, my friend. A great way to start the show indeed. All right, everybody. Any news? Any news today? The S&P 500 up 3.25%. The NASDAQ up a little bit more than 4%. The Dow Jones, your grandfather's favorite index, up 2 4/5%. And the Russell, the little engine that could, up 3 2/5%. Man, what a day! You know what I mean? In fairness, if you hate Orange Man, I get it. You know, I'm not going to defend the dude, but in fairness, he told you to buy him twice, and the first time stocks were up 10%. And the second time, stocks were up 4%. So no matter how much you hate the dude, I mean, he's insider trading on your behalf. You should probably start listening. Sorry. I know some people are going to be angry today. If you're short, look, I get it. Let's talk. S&P 500, my babies, at 5864 and change. And this is where it gets tough. Okay, so for all the positive sentiment here today and all the capitulation, quite frankly, you're going to hear today, all the I was wrongs or all the cope that's out there trying to explain or fit their opinion into some box that makes people seem like they were right when they were really wrong for 1,000 points in the S&P. This is what's crazy. You can be wrong for 1,000 points in the S&P and still be trying to do these mental gymnastics to make your view of the world correct. Regardless of all that stuff, put that stuff to the side. You're at 5,800 now. And I said to a lot of people at 5650 is where I started getting hedged up, which happened. I still had a little long delta. I was short the twos. I had a little short gold exposure. I was long silver. That did not pay. And I was long Bitcoin. So some of those things helped. But at the end of the day, the question is, now at 58 and change, you're 4% in to the upside, or 3 to 4% to the upside. What do you do now? And I think that's the most important. I don't know what's going on with this chart here. Why it's waiting for data. That must be on my end. If we could take that, we'll take the platform down. I'll restart it, guys. But the most important thing is not, the most important thing is not coming on air and try to cope with how wrong you were. The most important thing today is trying to help people figure out what to do next. And look, I'm no guru. I'm no furu in any way, shape, or form. I'm doing this just like you. I'm not coming out here trying to be right. I'm coming out here trying to make money. And at 58 and change, I got to be honest, people, I don't know that I see the same level of opportunity that I saw at 5,000 when everybody was freaking out. So call me crazy, but I got hedged up a little bit more. I moved my portfolio pretty close to neutral, and I think I'm early. Sorry. I do think I'm a little bit early. I think there's probably still more capitulation. There's probably still more people that still need to get long because, God, they were wrong.
but I don't know what I'm buying here. What am I buying if I'm buying the S&P 500 at 5860? I mean, I'm buying a trade deal between us and Argentina. You know what I mean? Like I'm buying a trade deal between us and like who else is more meaningful? And I don't know that we got specifics of the deal or enough specifics on the deal, I should say, between China and the U.S. But the point is that we've moved off of the embargo. We've moved off of an effective embargo into something that actually facilitates trade between the two largest economies in the world, and that's enough. That's enough to be a decent start. That's enough to show good faith. And I think, quite frankly, you want to know what's interesting? I think the market had expected the 10% universal base case tariff. For all the rhetoric that's out there, you can't listen to these people. The market priced, and we said this when this whole thing started, April 2nd, the market already priced about a 9 or 10% tariff. But the market was actually expecting like 60% on China. So to drop them to 30%, this thing went from way worse than expected to actually better than expected in 4 weeks. The 10% was expected, but the markets had effectively expected around 60% on China. So to get to 30%, to get to 30% is better than expected. So the question is, again, I'm sorry, I'm a little circular loop there, but the question is, what do you do now? I got the platform back up, everybody in the booth. Thanks. I'm not sure what happened there. And I think maybe you're playing from here to 6. I could see that happening. But I'm going to stay consistent. I was consistent at 5,000 to where I thought we could get. I thought 56 was in the cards, and I said I could totally see us getting to 5,800, but they're gonna get there without me for the last 150 points. We're there, and I also said last week, you can check the tape. This was last Thursday, people. When we were talking about the VIX, I said at 22 VIX that it's normalizing, it's getting a bit healthier, but it was still flat. It wasn't in massive backwardation, but I said the problem here is that they're flat at 22. And the problem with betting against a market at 22 is they're still hedged. Why would you? It's going to be hard for people to puke and run and get scared when they're hedged. They're hedged up to 22 or 23. And I said I would feel much more comfortable starting to sort of fade. And again, I'm probably too early here, but I said I'd feel much more comfortable if we can get back into a normalized term structure and 18 at VIX. Go check it. It was last Thursday. And guess what, my friends? Guess what we're looking at today? We're now looking at a normalized VIX term structure in contango. Oh, God, that thing is beautiful. It's been a while since we've seen you. It's been a while since we've seen a term structure that looked, let's say, what's the word I'm looking for? I don't know what's up with me lately, but it looks like people are not as afraid. Let me say it like that. I'll think of the word in like 30 seconds. It looks like people just aren't as afraid. Complacent. Gosh, that's the word I was looking for. It looks like I see complacency when I look at this fixed term structure. In fairness, what's there to be fearful about? You've got tax cuts on the horizon. You've got a better than expected trade deal with China. You've got a template now that a bunch of other countries can come to the table and feel like they can do a deal with the United States, pay homage with whatever billions of dollars they're going to give up to the U.S. administration and the American people without feeling like they have to pick between the supply of China and the demand of the United States. You've got a ceasefire here, a ceasefire there. What possibly could go wrong? And that might be true. That might be true. But I don't know. I'm not the guy who buys new highs. I've never been that guy. And I'm staying consistent. I thought we got awesome value down there at 5,000, even though it was just painful. It was so painful to close your eyes and make that bet. But I thought we had great odds. And here I don't love the odds, so I'm unloading. And I might be wrong, but I'm not gonna top tick this thing. I think we're more likely to get good value, not bottom tick, and get rid of decent value and not top tick. But when you don't pigeonhole yourself into having to be right every single day, that I've got to be on the right side of the market every single day, that's not the game here, people. The game here is to just try to make yourself and your family a little bit of money, and do it by taking decent odds that the market will give us. So that's VIX. We're back at 18. God, man, that thing looks good. And I really wonder, what do you do as a vol seller here? I'm not exactly a vol seller, meaning I'll sell vol when it's elevated and I'll buy vol when it's cheap. So, I don't think I'm playing blackjack with the right strategy. You know what I mean? If you're going to be a vol seller, you got to always be a vol seller, I suppose. But, 18, I don't love them. I don't love selling vol in 18. What was interesting about this earnings environment, right? Well, you come into the earnings environment at 40 VIX. I mean, clearly that was pretty good, a pretty good environment for selling vol. And I think Tom mentioned this yesterday, everything was a winner except Microsoft. They gave you so much room on a bunch of this stuff. And yeah, they're going to pull guidance. Who didn't know that? If a guy like me knows that before we start the earnings season, man, like everybody knows it. And it's priced. So that level of uncertainty gets priced into vol. You don't know what they're going to say about this quarter. You don't know what they're going to say about the future. You don't know what their guidance is going to be. So you widen out your distribution. And almost all these companies going into this had wider distributions than otherwise. We'll talk about Walmart here in just a second. I think Walmart, Cisco, Applied Materials, JD.com, and one more big Chinese company has earnings this week. The twos got even worse today. I closed this out. So I was short the twos, everybody. We had a conversation maybe 2 weeks ago. The question was, we were at 100 basis points. We're at 4 cuts and a possible. The question is, do you bet the over or the under? We had so many extremes, man. So many extremes. And I said I'm betting the under. Now, there's 2 different ways to probably bet the under. A more direct way, which is to sell the SOFR futures. That's not really my gig. Only because, I don't know, I've just never done it before. And sometimes you go to the devil you know versus the devil you don't know. So I didn't pick the SOFR futures. I went to ZTs to express my opinion that the short end would lift a little bit and that we would stop pricing. We wouldn't be pricing this many cuts into the front end of the curve. Not because I had any sense of what the hell was going to happen or what the catalyst would be. It just made more sense to me to bet the opposite of what everybody was running around screaming. We're in a recession. The store shelves are going to be empty. A 1930 style depression and like all this stuff. It's like, okay, I hear what you're saying. I think you're in a social media algorithm and you need help. You need to put your phone down. And I think because you won't put your phone down, I think because you're stuck in an algorithm, I think you're giving me really good prices. That's what just happened. Honestly, that's what happened over the last month. Several people spent too much time on their phones and don't go outside. They spent too much time on TikTok. They got locked in an algorithm. and then they spent a bunch of time with other people locked in the same algorithm. They said the same things to each other, convinced themselves it was true, and then gave people like me really good prices. ZT, I closed it out. So we were short. They lifted. They moved the Fed funds futures. They've come into like 50 and change basis points into the year. In other words, we've gone from expecting 4 cuts in the year until the end of the year to basically 2 cuts. So we took the under at 4, and they paid us. And I said, I think if you go back, I think this was just a week ago. I think it was on Thursday. I said, I think they're going to try to get away with somewhere between 0 and 2. So I said I was holding those short ZTs, but now they've priced what we thought might happen. They've already priced it, so why would I keep holding it? They've now moved to 2 cuts. And I don't love the odds of just playing for they take one more out. So I'm going to give up. I'm going to keep all my money on the table, just betting on one more cut to get removed. No thanks. So I think to me that trade's over. And even with all the movement in the curve today, we still have 47 basis points between the 2 and the 10-year. So that was basically what we ended last week. We ended last week with 47 basis points. So with all the movement today, you got no change in the actual curve. So that's why I think I want to close out the 2s. I said at the very beginning of this, when the Trump administration, when they started pivoting the rhetoric, we were at 65 basis points between the 2s and the 10s. And I said, I think that's going to flatten, and my target is 45 basis points. We got there last Thursday. And with all the craziness today, you mean to tell me that the curve didn't move at all? We're still at 47? To me, that's sort of a signal, and I'm done with the 2s. I'm a bit surprised how that flattener happened because the bonds didn't rally at all. The bonds actually fell a bit, and the 2s just rallied more aggressively. So I should say the 10s. The 10s didn't really move, and the 2s fell. And that's how we got that that flattening. So I'm fascinated by how we got there. I don't know if I should be terrified of that, because part of me thought buying the bonds at 114 was actually a decent value. I sold them at 117. I thought it might be early. Then they got to 114, and I'm kind of like, okay, I think these are good value. So I bought some upside call spreads today. But I don't know if that's the right move. I honestly don't know if that's the right move. I thought they would have rallied a little bit today. I'm sorry, I'm just really thirsty. 113 and 12. I'm sorry to be drinking on the mic. 113 and 12 ticks today. They came off. And this is the thing. I will respond to the chat here in just a minute, but this is the thing I did not see coming. I'm surprised at this. So Bitcoin kind of hanging in there. They gave up around 2,000 or 3,000 a day. Gold throwing up. I totally saw that. I kept saying that the way this negotiation goes, the worse it goes, the steeper the curve is going to get. The better it goes, it's going to flatten. And I also thought the worse it goes, the higher gold goes, the higher the gold price, and the better the negotiations go. Then, and by better, I just mean coming to some sort of conclusion, some sort of certain conclusion, that gold is going to give it all up. It's going to puke. And which is one of the reasons, again, go check the tape. Last Thursday, I said, we need to hedge Newmont mining. We need to hedge these miners. They've given us a lot of price action to the upside, but the rhetoric is changing, and it's time to hedge them. And guess what happens? Guess what happens on Monday? They're down 6%. You don't love me like you should. I'm going to be honest with you. You don't love me like you should. This is a free show, people. So yeah, but what I would have thought would have happened at some point if you inspire confidence, in theory, right? If you're inspiring confidence back in the U.S. U.S.-led financial system, I think you puke gold, you come off Bitcoin a little bit, but because it's risk on, you're not going to get hurt. But I actually thought there would be a little bit of a rally in the long end. So I'm a bit surprised today. So I got to figure out how to think about this, man. And what the implications are if we continue, if we see a rising long end right now, when people start to price, oh, I was wrong about growth, we aren't going into a recession. Goldman, by the way, Goldman puts out a note that they see growth at like negative 0.5% and recession odds better than 50-50. 2 hours later, 2 hours later, they put out a new note that shows growth will be just over positive. I forget the number they said. And that they see recession odds of 45%, so less than 50-50. These people are not helpful, man. I say this on Twitter. I say it on this show. Stop listening to people. Tune everybody else out and follow the incentives. These people are just scaring you away from your money. They're scaring you away from your money. And if you hate a person, an orange person, more than you love your money, they're going to take it from you. We were short the euro. I told you guys I don't really mess around with currencies that often. But at 115, I couldn't help it. At 115 the euro, I just couldn't help it. Everybody and their mom was betting the short dollar, the annihilation of the dollar. And I was like, you might be right, but I think you guys the trade's too crowded and you can't go any further when everybody's on one side of the boat. It tips over. So anyways, last week I was short the euro and today we got paid. And so the interesting thing about guys like me is I like to call the turn. I don't know, maybe it's my ego. Or maybe it's just like reading the room. I think I like to read when everybody's leaning one direction and then just bet the opposite just because. But we got a nice break here. And I closed out a lot of this position as well. It's funny too, because other people, more trend-like traders, they'll come in now because you just violated the 113, sort of this 113 trend line. They'll come in now and say, okay, now's a good time to pile in. So I don't know that this trade's over. I think this thing could keep moving lower. Who knows? Maybe we make it back to 108. 108 to 110. But I made my money. I'm closing out most of it. I let a couple of little ones ride. But I'm pretty done on this one. Let's interact with the chat, my bad. Oh, you guys are going off in the chat today. Notes are outperforming Qs and ES year to date, and everyone hates them. Yeah. A lot of things are outperforming the Qs and the ES, though. Aren't they like flat? I think they were down 5% coming into the week. Rumor has it Qatar is giving a see. Here's the thing about that stupid Qatari airplane story. First of all, people need to start reading. People need to read. If you haven't read Manufacturing Consent, you need to read it. I don't understand how you could try to navigate today's world never reading Manufacturing Consent. That's number one. Number two is that Qatari airplane story is like a week old. They ran that story like a week ago and nobody cared, and they reran it today because some people with broken brains need cope. And so I'm in Singapore, so I got 14-hour difference in time. So I logged on. I'm not going to call out the financial media site, but I logged on to a financial media site this morning just because I wanted to see what they were reporting about what was coming out of Switzerland. and my eyes almost fell out of my head when I went to the site. The first story, the big story on this website was that stupid Qatari airplane story. And it wasn't this massive story which had moved the markets 3% at the time. I could not believe my eyes. See, and I actually, when I looked then lower in the feed, I couldn't even find, there was nothing related to what had moved the markets like 3 to 4%. And I was like, see, this is what I'm dealing with. This is what people are dealing with. And if they can't think for themselves, if they can't understand the incentive structures that are at play, they've got no chance. They've got no chance of navigating this world. That stupid Qatari story is old, man. It's so old. And to be running it as like front page news after the news that came out of Switzerland, it's like, bro, you don't see? They're just trying to corral you sheep over here into like into a barn. All right. Catan says, let's start at 30%, raise to 125, raise again to at ludicrous speed, then back to 80. Now we are back to original. No, I sort of disagree. I think the market has thought it would start at 60. But here's the other thing that like people will say all this stuff and they keep showing that chart of the tariffs, right? How the tariffs are at almost nothing, then they go up to, like Catan says, up 30, up 125, up 80, and then they drop down to 30. And they're somehow use that chart to rationalize like how erratic this was. But it was all just a poker hand, man. It was all an attempt to create leverage. And whether you think it worked or not, I think judge it by what the end result is. Not even today, because I don't think there's enough details about what the agreements are going to be between the U.S. and China to even make a judgment on whether this is all face saving or whether this actually moved the dial on tariffs and non-tariff trade barriers. I actually don't think there's enough information. So we'll see. And the people who don't say that, the people who don't go, okay, let's see what we get. Do we actually get more money, more investment? Do we get a lower debt trajectory? Do we get consumers elsewhere in the world that are going to be lubricated with local debt in order to buy our goods that we will sell to them? Is that all going to happen? There's not enough information yet. So the only people who are telling you with conviction what is going on are the people that have a vested interest in that outcome. They're starting with an outcome and they are just trying to pick pieces of information that make their outcome sound more likely. And the truth is, we just don't know. That some of this created leverage may have been beneficial, some of it may have been unnecessary. And at the end of the day, we'll judge it by the terms of trade, where we land in the terms of trade. I just know somebody's just seething watching the stream. Like, you're wrong. Why won't you believe me? Why won't you set your hair on fire with me and believe that we're headed straight to a 1930s depression? Why won't you panic? And why won't you tell everyone to panic? Some of these people, they were only going to be right if we went into a 1930s depression. Think about that. Their whole worldview relied on a 1930s depression. And then so that they could say, I told all of you guys, look what all of you guys did. And they wanted to be right more than they wanted that not to be true. Think about that for a second. Mark says, it's a great day, even though I'm more short than last night and added to my future short at close today. Pain before gain. Mark, I'm with you, actually. So I was a little bit net long coming into today. So the people who were just long today, they outperformed me. So markets are up 400 basis points. I probably did half that to the upside. Not ashamed to admit it. And so I hedged. I took a lot of so the short euro trade I took off, the short twos I took off for the most part. I'm letting a little bit of that stuff ride, not much. So all the stuff that I put on in the portfolio to try to offset what would happen if we got some more upside, I'm taking a lot of that stuff off, and I added to some hedges to the downside. Son says it felt pretty easy to sell them today. Might regret it, but it felt good. See, this is where I get nervous, man. This is where I get nervous. I had the same feeling at 36. I had the same feeling at 36 that the bearish sentiment, it was clear that it was there, that people were they were not committing to the market, which meant the market's got to turn people into chasers. It's got to turn you, it's got to make you chase them. It's got to make you capitulate to the upside, because markets capitulate on both sides. And I really, really wish that I would come in here today and I would say, I'm selling them at 58, and everyone say, you're an idiot. You're crazy. We're going to 6, this new all-time highs. And we're not there yet. That makes me a little bit nervous. Treasury yields soar. Rate cut is off the table. That's correct, Jeremy. I don't know that I'd say off the table. I would say a lower trajectory of rate cuts. And I would also say they've moved it back. So not June, not July. It's in September now. That's wild. I mean, for most of the year, for almost all the year, this rate cut was coming in June. And now all of a sudden, we're talking September and only 2 cuts for the year. I almost want to ask you guys, let's do the over-under game again. At 2 cuts for the rest of the year, do you take the over or the under? This is actually hard. I think 4 was easy. 4 was easy to say you take the under. 2 is very difficult. Over or under, 2 cuts from the Federal Reserve from now to the end of the year. I want to see what you guys say. Son saying, absolutely love bonds here. I bought them today too, son. That's my new position. Who knows? I might be just wearing that like a big old idiot, just like everybody else who's been buying bonds. But at 113, I'm going to give it a shot. But I didn't buy them outright. Normally when I'm trading, when I'll trade like bonds or the twos or euro, all these futures, I trade them outright. A lot of the times. Or I'll do both, options and outright. In this case, I don't have enough confidence in the long bond to get outright long ZB futures, so I'm just long call spreads. Catan says, I'm going to let Donnie negotiate with my ex-wife now. That's pretty funny. That is too funny. China didn't care, Victor. About what? Now you're talking 68 in the lower drug prices. So yeah, the lower drug prices, I'm so suspicious of that. First of all, what's his name? Jim Carson, his immediate read was these are price controls. It's a form of price controls, which is I'm speaking the president. I don't know if he already signed it, but I just saw the tweet about creating and signing an executive order that would ensure that the United States has the most favored nations terms when it comes to drug pricing. And I saw that and I go, I don't think that's going to be good. I don't think, like, to me, okay, let's do an example. Okay. I'm really, like, I'm a simple dude, man. You know, when I think of this stuff, I'm like, you got to explain this to me like I'm 5 years old. I'm going to break it down to the simplest terms possible. Other people want to play in the world of complexity. I don't. I just go, okay, if our prices are here and their prices are here, you mean to tell me you're going to bring ours down a bit and you're going to jack theirs up above ours? And jacking the world's prices up above ours then helps to subsidize giving us a slightly lower price? I was like, I think that's a net. What should happen, if this was in any way, shape, or form, if this is good for the consumer, the prices of these healthcare stocks should not be going up. And they went up today. So you explain to me why healthcare stocks are up 3 to 4% today if they're going to be hurting for money. Explain how that works. I'm not saying that Americans' prices won't go down slightly, but if, let's say, it's kind of like, let's say we're buying insulin for $1,000, and then we go, hey, how come they're buying insulin for $20? And they go, okay, we're only going to charge you $800 now, and they're going to pay $1,000. And are you going to be happy? You're going to be happy, like, okay. Or is anyone going to go, why don't I get to pay $20? And when I read all this stuff, I'm like, our prices are not going down to what theirs are. Their prices are going up to where ours are. And that's going to be a net positive for healthcare companies. And wouldn't you know, and I was like, all right, I got to get some sleep. So I went to sleep for a couple of hours. I wake up and all the healthcare stocks that I own are up 4%. And I'm like, yeah, I think I'm more right than I'm wrong. Just follow the incentives, people. Don't listen to these people. Don't listen to these people. But in fairness, if you don't know what another country paid for the drug, if you're completely ignorant to that concept, then all you know is your prices went down, right? So if you're completely ignorant to the market on these drugs, you're just going to kind of be happy. Getting a slight discount. Perspective is a wild thing, bro. You don't hedge. Catan says you don't hedge with VIX at sub 25. I would argue the opposite. What I think is true, Catan, is that at sub 25, no, I totally disagree with this. Every part of that statement, man. I think above 21, you're starting to get into the danger zone. Once you get a VIX above 20, you have a higher probability of spiking higher than going lower. And at a VIX below, let's say, more towards historical levels, so like 18, you have a higher probability of autocorrelation. In other words, you have a higher probability of continued move to the upside in S&P price, continued move lower in vol terms. But depending on what the setup is, you can have a fatter, growing left tail. So it depends. What are you hedging for? Some people call hedging. Some people call it hedging, but really they're bearish. And I call hedging doing something about the left tail. In most cases, for most people, it might be the right tail for some, but in most cases, it's doing something about the left tail. And in my personal opinion, you start to do that well before VIX is at 25. If you're doing it at 25, you've already missed the opportunity in a hedge. You know, if you think about buying low, selling high, your hedge at 16, 15, 16, 17 is where you want the hedge, and you want to be starting to unload it at 25. All right, I'll do a couple more and then we'll keep moving here. You guys were super active. Buying a hedge with VIX under 25 is backwards. I think you're so, I don't know what you're talking about, Katan. I love you and respect your point of view. I don't agree with what you're saying at all. Sun saying the flattening yield curve will blow up a couple banks. That's interesting. I had not thought about that. I think it depends. I don't know if 45 basis points right now is enough to blow them up. I think if we keep going, we could see a couple of people who were doing some silly things, getting put in some tough positions. Short stocks, short vol is probably the best risk-adjusted position right now, says Sun. Here's my thing. I don't necessarily disagree, but I'm not net short. I want to be very clear. It's a very nuanced thing here. I am flat, which means I've on a beta adjusted portfolio delta. My beta weighted portfolio delta is flat. It's not net short. And why is that? Because I don't think we're necessarily expensive here. I think 58 is probably about right. It feels like decent value given what's happening in the market. But I don't know what could happen. And I still think we got a decent left tail here. And what possibly I could totally see this happening. We get to 6,000 and it's going to put me at a decision point. Because at 6,000, I'm going to feel uncomfortable. At 6,000, I'm going to go, ugh, should I lift the hedge here? And then at 6,000, you get the puke down to 5,800, right? So I think it's a really tough little game that we're in. It's a tough little poker game that we're playing. And if we get to 6, I'm telling you, for all of you that are like short or you are hedged up, all of us are going to get put to the same decision point that everyone else at 4,900, those people got put to. The market's going to put us to a decision point at 6,000. And so all I'm saying is think through what you want to do if and when you get there ahead of time so that you don't get put there and now you got to come up with a strategy all of a sudden. Anyone else feel like this is a whole huge bull trap, says JMG. Gosh, I really wish you guys were more bullish than you are. There's so much bearish sentiment here that I'm like, I just want to close the laptop and go, we're going to 6,000. I got to figure out what to do. Yep, Billy gets it. Billy says, no, sir. Every bear thinks it's a bull trap since 5,500. That's right. That's the tough part. All right. There's so much more to get to, but I got to keep going here. Bitcoin gave it up a little bit today. Moved off of 105 in the early part of the day down to 103. I wouldn't be surprised that this thing backs up a little bit. I'm not selling. I think we get new all-time highs here in Bitcoin. So I'm going to hold them. And it's also, like, if I'm wrong, the correlations could break down here. And you could see Bitcoin come down as equities move up. Because some equities, and Tom says this, and I think he's right, I think some equities offer a better vol-adjusted return than Bitcoin. So it is possible that sort of Bitcoin breaks down here while equities go higher, which is the opposite of what they just did, right? In March, you saw Bitcoin sort of staying in the pocket between 80 and 90 while equities were getting demolished. And it wouldn't surprise me to see the exact opposite here, where Bitcoin gets a little softer while equities continue to rally. I think that is possible, but I'm not sure that I get hurt. I don't think I get hurt badly owning Bitcoin here. That may be my famous last words. What happened to Victor? He went unsecured owning Bitcoin when the markets were rallying. I don't think I'm going to get hurt, so I'm going to hold this one. So I'm going to stay long. I completely missed the ETH rally. I completely missed it, man. And I will probably always miss it. There's some part of me that sort of looks at myself and I go, to buy 1,400 ETH. You know that, But I didn't. It just completely got past me. There was no part of me that even checked the ETH charts and said, or even the price. So that's just my bad. But a sick rally in ETH to the upside. I'm not going to chase them. I know even if you look at this chart, knowing it was at 4,100, it's still probably attractive to some. And that might be true, but I think you're really close to midpoint, right? 3,000 is probably your midpoint. Plus 1,000 gets you to your highs. Minus 1,000 gets you close to your lows. So I don't know that you've got a ton of value here, right? Maybe you're trading 400 or 500 to the upside to get to some midpoint. No, thanks. And then how about gold? Oh man, can you imagine if it breaks 32? So we sold 3,500. We bought back in the 32 ballpark. It was 32 something. I think it was like 32.50. I bought them back in. It rallied again. I didn't sell it the second time. I think I was only short upside call spreads. So I'm still short the 3,500 with something long behind it. But I did not fade this second move in gold, really. The only thing I did was I said, you know what, we should probably start hedging up the miners just in case we get some weak gold here. And I think depending on the continued rhetoric out of Switzerland or between Beijing and Washington, I still think there can be a little bit more downside here. It would be nice if they could just break 3,200 and we can go find a real price, right? Without all of this excess geopolitical premium, this negotiating trade war premium. If we can go find the real price, two things are going to happen. We're going to get cheaper mining prices, which I still think are under-owned, and I would love to accumulate more miners at a cheaper price. And we're going to go find a more normalized gold price that we can hang around for a while. I'm not sure if the gold rally is over. I said this on Twitter. I'll say it again, just in case you don't follow me. If you'd like to, it's at Victor Jones. The Owen Jones is 0 because I like to be difficult. But the one thing I mentioned was, like, I don't know if you guys listen to as many podcasts as I do, but I try to, with as much of my free time as possible, I try to listen to people that I respect, objective people that I think have interesting, unique, nuanced points of view. And I try not to sort of pollute my my thought process with people that just regurgitate stuff that they read in the New York Times or the Wall Street Journal or sort of like in their social media feed. I try not to listen to those people. But in a lot of the podcasts that I listen to, for one reason or the other, and it might be sampling bias because of the stuff that I like and I listen to, but I said this on Twitter. Dollar devaluation? Question mark? Sure. But the trade is crowded. Gold is a haven? Question mark. If you were paying attention for the last 5 years, it's up 100%. Is the trade getting started or nearing its end when every podcast I listen to pauses to read an ad for some gold product? You decide. So my point here is, and I like anecdotal evidence. I kind of do well with anecdotal evidence, just watching things around my real life. But is that just my personal experience, or all the podcasts and the videos that you're watching, are you seeing a pause and people are reading you why you should buy gold or some gold product on all these mid-roll reads in these podcasts? Is it just my personal experience, or is that's true for you as well? And if it's true for you as well, I don't use it. I'm not going to trade off this stuff, but I do use it to sort of inform my opinion. When I look around and everyone's going, "Hey, buy these gold nuggets," and I'm like, how come everybody's telling me to buy physical gold? And at some point, once everyone's trying to hawk gold coins to the general public, should I be long that instrument? You know what I'm saying? Are we at risk of potentially being oversupplied? And what happens when you get oversupplied? Price goes down. So I don't know. It's some anecdotal evidence for you guys. Am I the only one? All right. And the other one is copper. I can't figure out what to do with copper, honestly, so I've stayed away from it. I dabble with copper from time to time, but now I just can't figure it out. And the only thing I'm doing is just trying to buy a little bit of Freeport when they give me cheap prices. So I bought a little bit over the last month, probably not enough. Silver, we didn't get our breakout. We did not get our breakout today in silver. And this is another one that I'm surprised. I'm sort of surprised about the long end of bonds. And I was surprised. I thought what was happening is you were getting a monetary premium in gold, and you were getting basically a growth discount in silver. And so these type of announcements would take off the monetary premium in gold, and I thought it would also take off the recession discount in silver. That didn't happen. At least it didn't happen yet. I did not change my position. I'm not changing my opinion, but I am noting cautiously that I would have expected silver to do more to the upside. And maybe it's just going to be a delayed reaction. Maybe I had the wrong mental framework. But I'm long call spreads in silver. The initial move in silver today was actually down. And so it actually allowed me, so when you're long a call spread, you're long a call and you're short a call behind it. That move down allowed me to buy in my short calls at really cheap prices. So now I'm just basically long some upside calls in silver. And if we get a little bump here, a little rally, it's going to work out even better than it would have otherwise. But if not, this trade's on its last legs. I'll go back to the chat for just a second. Let's see here. You should listen to Charles Hoskinson, ADA CEO, if you want to learn about crypto, mostly YouTube. I like Charles. Every once in a while, I'll tune into what he's saying. I think generally speaking, when I listen to Charles, I get a little bit smarter. He's clearly a well-read, well-studied individual. He puts a lot of thought into his ideas and his opinions. Yeah, so I'll tune in every once in a while. He's not the most exciting person to listen to, though. I suppose that's how you know if you're listening to somebody that's full of narrative fallacy, though. Or just, somebody, a jokester. Anyone listen to Hugh Hendry, Acid Capitalist? Yes. I haven't listened. I know he just put out some new stuff over the last couple of days. I haven't listened to it. Speaking of miners, are you a buyer of PAAS here, which is Pan American Silver? Zero expiration says, I'm long Pan American Silver already. Ooh, I didn't see that move. Probably. Yeah, probably. You actually just got me excited about something today, Zero. Something to buy. Yeah, I'll probably pick up some of this stuff in the extended either tonight or tomorrow. Catan says, I can't short the Qs right now. There's no juice there, Victor. One day spike. Chaz says, even if trade deals happen, we still have fired veterans from the VA. We have a reduced OSHA staff, reduced Department of Education, reduced Social Security. Okay, what I'm going to say next, people are not going to like. So I'm going to do my best. I'm going to do my best to thread a needle here. But I might need to end the show after this because I'm going to lose all my viewers. The people voted for a smaller government. And I think there's a group of people that don't understand what that means. So they keep seeing these headlines, which are designed by political opposition to get you to feel something. So here's what I believe. I believe we should be taking care of our veterans. And I believe it's sort of ashamed how the uniparty, both sides of the aisle, have cut resources for our veterans, while simultaneously increasing the budget for defense, which only really has created a bunch of new veterans in pointless wars that have saddled this country with debt. So let me say that first and foremost. But like, some people will get upset no matter what you cut in the government. And I think at some level, it's like the same people who are upset about what's happening with the VA were upset about USAID, right? USAID. And it's like, all right, well, which one of these things, the people voted for smaller government, which one of these things are you going to be cool cutting? And if you don't have an answer for that, man, then I kind of can't listen to you, because you're just going to be upset at any and on all problems, and so I would much prefer we start having positive, productive discussions around what areas of government people are willing to say, you know what, let's stop spending money here, right? Department of Education is another very controversial one, because a group of people will say, we can't cut the Department of Education. And then I'll go, but we spend 30% more per student than the OECD average, and our results are sliding relative to the world. Why is that? If this is a positive function, then why is it that we are having such worse results? and we're spending so much more? Where's the money going? And people can't answer that question. So, look, I'm not saying, you know what, we should slash the DOE. I'm not saying we should slash money for veterans. I mean, that's not what I'm saying. Please hear the nuance in my point. My point is that if any cut to government can be you can create a news headline and they can throw it in your feed and they can spend millions of dollars to get you to see it through an influencer or just paying Facebook outright. So people can elicit emotion on anything. So my question is just, okay, I get it. Let's not take any more money away from the veterans. 100%. Where are you willing to sacrifice? Where are you willing to acknowledge that the people voted for smaller government, and what are you willing to give up so that we can have a negotiated settlement that you're happy with, or maybe you're not happy with it, but you can live with it? And I don't think we have those conversations. We just have a bunch of people talking past each other. We got a bunch of people that are happy that there's less money to veterans, and a bunch of people who will just flip out over anything, over stuff that actually is not wise spends of money. You know, people doing mental gymnastics to try to prove to themselves that, you know, some of the money that we were sending abroad to do these weird experiments, like that they were good uses of money. They just weren't. And it seems like we just can't meet in the middle for a decent conversation. And if the people don't have a conversation and then have a negotiated settlement, you know what happens? You leave a void. You leave a complete vacuum in the middle for somebody else to have that discussion. And then they get to choose. And that's how you end up with a government who's cutting from the VA. And they didn't cut from Social Security, man, yet. I hear that all the time. That is a headline that has not happened. And here's what's even worse. You know what's even worse? God, I'm going to get fired. You know what's even worse? Let me explain to you what happens in 5 years, okay? We don't have the money to pay out on Social Security. Do you understand? Like, we bought these bonds. The bonds were spent. We have pieces of paper that are unfunded. So in order for the government to fund those payments, do you know what they have to do? They have to take out new debt. So let me explain what happens. They they borrow money, they devalue your currency, and they're going to pay you back in dollars that have less purchasing power. So what you need to understand is that even if we fix this problem the way that they're likely going to fix it, they're going to pay you back in a currency that's not worth as much. You cannot buy as much. So even paying you this stupid money in 10 years, even giving you your $2,000 check, it's not going to buy what it buys today. It's going to buy a fraction of what it buys today. And none of us are having that conversation. We're all leaving a huge void open. And what's going to happen is in 5 years, we're going to run off a cliff and somebody else is going to get to make the choice for you because you've just been distracted. And you've been upset and you've been arguing with the guy across from you because of the color of the hat he's got on. And you didn't recognize that it was your civic responsibility to have a conversation with each other and get a negotiated settlement. And the more you guys do not do this, the more they are going to choose for you. And the more they choose for you, the less money you get for your schools, the less money you get for water, clean water, the less money you're going to get for infrastructure. The less you care and negotiate with your neighbor, they're going to choose for you. And they are not going to choose the same shit that you would have chose. Sorry. Is anyone left? Is anyone here? Is this thing on? I'm sorry. You know, if I could say this, March of last year, I came back to start doing content again. And I told my wife before I started, I said, I'm going to say something meaningful this time. I'm not going to avoid the hard things. because there's a way in this business to avoid the hard things. That's why people say phrases like, I'm cautiously optimistic. It's a total cop-out. It's bullshit. It means nothing. That means I don't have an opinion, and I'm hoping positive drift will make me look smart. So I told my wife, this time I want to say something of substance, and it's going to make some people upset. It's going to mean this time some people are not going to like me, whereas I spent most of my career trying to say the thing that would be palatable to the largest amount of people. And that maybe it worked at some level, at some extent, but it wasn't meaningful. It wasn't true. It wasn't authentic. Being afraid of people disagreeing with me is no way to live. So I said, I'm going to say the thing this time. And after like over a year of saying, I think some part of me had some naive ego, like I can fix it, I can make a difference. Like somehow my voice in this sea of voices is going to cut through, and I'm going to be some like revolutionary character. It's going to lead us to the promised land. Like these are kind of the delusions that the ego can talk you into. And like a year later, I'm like, bro, like nobody cares what you think. you can. The delusion was probably the first time thinking that somebody cared. But I kind of think I'm directionally right on some of this stuff. That not getting bugged out and going right and going left, putting people on the spectrum, understanding most of our issues are class related. Most of this stuff is a distraction away from the things that are important. That populists like Bernie Sanders are really only exist on the left side to tell you what is your acceptable boundary of discussion, and same on the right side. I think I'm like directionally right on that stuff. And I think the fact that I don't know. Sorry, I'm sort of like talking about myself right now. Who the hell cares? So where do we go from here? It's a pretty big week, my babies. This is a wild show when you think about it. I got a lot of respect for people that listen to this show, because I don't really know what this thing is. I don't know what it is. CPI tomorrow. Markets are betting 0.3% month over month. The range 0.2 to 0.6. I don't have a bet. I don't really have a bet. I think inflation is a boogeyman right now. I don't think you should be worried. I don't say you. I am not worried about the upside in inflation. And I think that might be sort of a mistake. It might be a mistake, but you got to have an opinion. So I think the upside in inflation that everybody has been sort of yapping about, I think that's probably mostly wrong. I think we'll probably see inflation cool into the back end of the year. I'm not sure what the Fed will use. I'm not sure if they'll use lower inflation as a mechanism to deliver cuts, or whether they'll use it as an excuse not to cut. I'm not really sure. If inflation cools, I'm not sure how the Fed responds. I do think if they cut, then you're sort of left with a situation where bonds probably stay right here. I don't think we go very far off of 117. But if the Fed doesn't do anything and inflation cools, I kind of like bonds here. And I like them for the exact opposite reason. This is the funniest thing, man. That everyone that wanted to buy bonds in a recession, it was a horrible bet. It was a bad bet. And I think it's a bad bet because why would you be buying bonds at 7% debt to GDP? And now you got to start paying people unemployment. Now you got to start subsidizing your farmers because you just blew up all their buyers in the world. Now you got to start subsidizing all the small business owners that own these like e-shops, they've been buying cheap goods from China. Effectively, by the way, we need to have a conversation about the small businesses that do go out of business because of these tariffs. And I don't want to see any small business go out of business. I'm going to make that very clear. I am not cheering anyone going out of business. But what we should say, what we should be clear about is that if these tariffs at let's say it's 30%, if that puts you out of business, your business was purely monetized on labor arbitrage and you just didn't know it. Maybe you knew it, maybe you didn't. But you were effectively, the only margin you could create was on the fact that the people getting paid for this stuff were in China and not in America. You don't have a differentiating business to the extent that you can survive. And I don't want you to not survive. I want all those businesses to figure out a way to be fast, to be smart, to be flexible, to pivot. And I want them to be successful. But we do need to have a conversation about, because you're going to see it, all these stories around small businesses, they're going to close. And I don't want to see them close. I want to be very clear. But there should be some room for a conversation that it was purely labor arbitrage. And that labor arbitrage is reverting. It's getting normalized. And that's going to cause some pain. And I think you got to have a conversation about, like, is that at a societal level a good or a bad thing? I'm not advocating for it. I just want to open up a pathway for a conversation that hopefully reasonable people can engage with that subject and that topic. But anyways, I do think inflation isn't the boogeyman that the Fed is trying to make it. I think they're using it as an excuse to stay put. And maybe that was the right move. Maybe it's the right move for them to come out and say, hey, inflation's going to spike to 2.7 and 2.8 instead of 2.5 like we thought. And that gave them, at least in the short run, while everybody was freaking out about tariffs, it gave them the opportunity to sit tight and not necessarily make a move. But back to my point, the point was that buying bonds into the recession seemed like the sucker's bet. Buying bonds, if we're not going to be in a recession, and if we're going to get a lot of these sort of trade negotiations, or at least some sort of understanding about what the world in trade looks like, to me, that's actually an interesting bet. It's the exact opposite of what everyone's going to say and what their narrative should say and what their history books and their textbooks and all their data fitting will say. And that's probably why I like it the most. I like buying bonds in a world where, if we get to 6,000, what's the better bet? Buying stocks or buying bonds at 113? Bonds, bro. Capitalize gains, socialize the losses, always. Man, that's what they do. People are going to figure it out one day. And the thing is, it's like, I'm going to explain to you one last thing. I'm sorry, I don't know. I'm on one today. I don't get it. Here's why I don't freak out. Okay, you want to know the reason why on liberation? So not even. What was the day that bonds were spiking? Was it like April 6th, April 5th, April 6th, April 7th, something like that? You want to know why I don't freak out anymore? Because I'm 39 years old, okay? And in every time in my life when I got fearful, my fear was used against me. It was used to pass the Patriot Act. It was used, and I'm taking off my shoes at the airport right now. Meanwhile, the NSA has the right to come into my phone and read my emails and my texts with my family and loved ones. Give me a break. Every time I got fearful We invaded some country over some bullshit, and we spent trillions of dollars on stuff that we have nothing to show for anymore, that are in the hands of some defense contractors and NGOs somewhere and political elites. And my kids don't have anything to show for the decisions that were made. After GFC, my fear was used to pass TARP and QE1 and QE2 and QE3 and QE4 and help to create wealth inequality in this country that will take, if we ever normalize out of, will take generations. If we ever pay for the stuff that my fear has bought, it will take my kids' lives, my grandchildren's lives, and my great-grandchildren's lives. So you'll have to excuse me if every time something happens on the screen, I don't freak out anymore, because I'm tired of my fear being used against me and monetized as new debt to fuel this bullshit. To fuel things that don't benefit me or my civil liberties. You know? When are people going to wake up and recognize that it is the crisis that is being monetized? Do you get it? It's your fear that's being monetized. And the people that came in here in early April and they got mad at me because I wasn't angry and I wasn't freaking out and I wasn't saying this is the end. Well, guess what? We are 1,000 S&P points later, and they monetized your fear for 1,000 S&P points. Who was right and who was wrong? You know, go back and read the comments in these videos, people. Go back and read them. It's not these ones. It's the ones on the Tasty Trending channel that monetize people getting freaked out over nothing. So you'll have to excuse me if now until the day that I rest, you cannot make me fearful anymore. I will look at everything objectively, and I will not allow my fear to be monetized or utilized against my own civil liberties until the day that I pass from this earth. That's the promise I make to myself and all future generations. Bro, you can't scare me anymore. How much shit have we been through? Come on, people. How much shit have you been through? You don't recognize the game anymore? Weapons of mass destruction, fucking a virus that you don't even... It was the most deadly thing 5 years ago, and now you don't even think about it. Nothing changed, man. Nothing changed except your fear. At one point, we had leaders that said there's nothing to fear except fear itself. And now the same leadership class is trying to freak you out over everything, because they know when you get scared, you just go, somebody, please make it okay. And they go, okay, we're going to pass this 300-page bill that you haven't read, or 3,000-page bill you haven't read. Okay, just make it go away. You don't even read the shit. Sorry, I don't know what's up with me today. I'm sorry. I don't know what's up. But I also think, like, don't over-rotate, man. Because the other thing, they monetize your greed, right? Bitcoin gets to some... Here's the wildest thing. Bitcoin's at 105,000. Last time it was at 105,000. It was nearing 100,000, bro. It was in every Uber driver was talking about it. It was in everybody's news feed. And guess what happens? It dumps. Right? It goes from 80 to 20,000 when it's at peak. Why do you think that happens? Do you think that's an accident? If you think that's an accident, man, like, this is not the game for you. This is not the game for you. 6 people own all the media in your country. Do you understand that? 6 people, bro. 90% of the wealth is held by 10% of the owners in this country. And 6 people, 6 corporations own all magazines, TV stations, radio. 6. If you haven't figured this game out yet, bro, this is not the game for you. If you're reading an article and then going, oh, I'm informed, and then go press the button, it's like, bro, you're going to get murdered. You're going to get murdered. All right. I don't know. I got to get out of here before I get fired. Thank you, everybody, for listening to this 90 minutes of I don't know what this one was. I I don't know what this one was. I don't think there's much to talk about, honestly. The move's over. Maybe we get to 6,000. I'm pretty hedged up, and we'll see what happens. I don't think there's a strategic edge to taking a bet either way. I think the people that say there's too much bearish sentiment that we can get to 6,000, I think that's logical. I think you could give it up tomorrow, and it wouldn't surprise me either. So I don't think there's a bunch of edge right now, and that's not a market I provide a bunch of value in, so we went a different direction today. Hopefully it was interesting. Hopefully it was entertaining in some way, shape, or form. If you disagree or agree with anything I've said, you're more than welcome always to respond. And I hope you guys know by now that you'll always have an objective audience with me. Even if you disagree with me, I will explain my opinions, and I'll always do it respectfully as long as you are as well. So if you want to engage, at Victor Jones, the Owen Jones of zero, because I like to be difficult, and you can send me an email, victor.jones@tastylive.com, if you want a more personalized or one-on-one discussion versus doing it out in public. I sincerely appreciate all you guys showing up here. I wish I had more sort of trade ideas for today, but I think the trade idea was 4 weeks ago, and we just sat on it. We sat on a sick, fat pitch, and now we're at 59, and you just listen to all the cope that's out there, and then you hope that they give us a new pitch. Maybe the long bond now, when they're all going to ditch the recession calls, is actually the play. I kind of like it. I like it because nobody else is going to like it, and those are the ones where that's where the money is. All right, everybody. I'll see you tomorrow. Peace.